The street, if you like, on the forecast side of things. So we'll have a bit of a conversation about that, and we'll bring in some geopolitics as well, because we've got to talk Ukraine. There's an important conference going on that subject. But for the moment, still very much about these earnings and how they go down here in Europe.
Yeah, and I think there's, again, we're talking a lot about the macro, we're talking about the micro as well, and I still really think that it's the currency picture at the core of all of it. We're going to dive into that in just a few seconds.
Okay, markets are open here in Europe. It'll take a few minutes for everything to settle down. The FTSE 100 will give us an initial price. I expect that you are going to see some of the continental markets coming under a little bit of pressure this morning. Certainly the DAX and the CAC 40 have got single stock names that are going to be a little bit of a problem. The stock 600 is opening. It's beginning to weaken up a little bit. We're already starting to get some of the numbers coming through. Sodexo looks like a big early loser that we haven't flagged already either. It looks like Sodexo is falling really quite substantially. I'll come back and figure out exactly what's happening there. But the stock 600 is down a touch in terms of what we're seeing trading elsewhere. I just want to get a kind of read on what the FTSE is. So the FTSE, as expected, is flat. It looks like some of the continental markets are down by 2, 3, 4/10 of 1%.
Sodexo has spun off part of its business,
right. Okay.
Which is debuting in Paris at 28 euros a share. So
that's a spin-off. That's just a mechanical process.
Seems like it.
Okay.
That's part of that story, at least. In terms of the sector picture, then I did see that energy was an early gainer, and just checking in on that, whether that's still the case. London outperforms just a touch, Guy, as you were suggesting, up 1/10%. Energy is the best performing sector across the whole of Europe, and that is a Shell story. So that's one of the best performers this morning in the energy space. Shell up by 1.7% right now. Total Energy is also trading higher, as does BP. So there's the buyback. There's the underlying performance on the gas business. That was supposed to be one of the things to watch coming into these numbers.
BT is also higher this morning. That's a factor for the London market. So the old British Telecom is tracking a little bit higher. In terms of where the points are really, in terms of where we're taking a hit this morning, actually, let me show you the top performers. You'll be able to get an idea of what is going on here in terms of the upside. Downside, Roche looks like it's taking a hit. Sanofi is down as we anticipated. Some of the luxury names are also softer this morning. There are the gainers and the losers. If you are over 50, maybe over 45, you may slightly be struggling to read that. I can see Anna leaning forward. I'm not suggesting she's in that age bracket, but maybe that's quite tough to read. But yeah, they're some of the big losers that we're seeing. Roche certainly is one of those stocks that is under pressure.
I don't feel unnecessarily like I'm in an optician having an eye test.
You are leaning forward.
I was leaning forward, I'll confess. But yeah, my aging eyesight. But Roche, yes, certainly under pressure today. And it's interesting because we spoke to the boss and we said, you know, your guidance might land a little disappointingly today with markets. Is there upside surprise? He was telling a sort of more positive story about some of the trials that are still to come. But of course, we had a conversation about the disappointments.
They've had really big phase 3 issues, and they've got to figure out how to make their research work better. They've got a pipeline that is coming through, but they need to have some successes in phase 3 in order for the market, I think, to buy into the strategy.
Can I just say I saw that screen just fine. I don't know what's going on with you guys.
This really doesn't surprise me.
She's showing off now.
I'm totally bragging.
She was talking about the fact she was an A+ student yesterday.
I
now
think
she's showing off her eyesight.
my new thing on the show is going to be a brag a day, I think. And today it's the good eyesight. And not to mention
that one,
the good strong contact prescription lens. Anyway, you mentioned the top 5 contributors, and you forgot to mention Novo Nordisk is again still leading. It's right on the tails of Shell as well, which is interesting because even though we got this kind of healthcare move, we got those numbers out of Roche, out of Sanofi as well. Why is Novo Nordisk still the outperformer? Is that just the go-to play now, the way that ASML is the go-to play for tech?
Take money out of Roche, where do you put it?
Is that simple?
Okay, it might be that simple, but I think you get a day two effect coming off the numbers as well.
Adidas has just opened up or down, as the case may be, down by 6% at the start of trade, 5.9% weaker on the back of a profit warning basically coming through from them overnight.
Yeah,
and on the ADRs yesterday.
So Adidas, I think, is a really interesting tell on the consumer as well, and you've obviously seen the ripple effect already into Nike, etc. But what it tells us about consumer strength and the fact they're talking about a stronger US, I think, is absolutely fascinating. That consumer continues to do well.
Definitely just need to mention Volvo Cars, because we've just seen that one really move at the open, and there's some specifics around that, gaining 30% at the open after their fourth quarter profits, and the Polestar distribution plan. And going into these numbers from Volvo Cars, this was always going to be a feature of the conversation. They're evaluating distribution of Polestar shares to shareholders.
There's lots of analysts out there that think it's worth nothing.
Yeah.
And was it a mistake to list it? So they're now having to go back on that.
They're revisiting that.
We have an interview with the CEO shortly as well, but I want to circle back to the Shell story as well, because again, it is one of the biggest movers. We're talking about this massive trading profit when it comes to natural gas. This has been the story in the United States, and that's what seems to be driving these numbers.
Yeah, so Shell maintaining their buyback, as you say, gas trading, that part of the business doing okay, that part of the business trading well, providing a profit beat. Let's hear from the CEO of Shell, who speaks to us now.
What we guided to is 30 to 40% of our cash flow from operations coming back to shareholders, so shareholder distributions. What we saw in 2023 is we were slightly above the higher end of that range at 42%. As we continue to deliver the strategy, the whole point and the whole focus of the strategy is creating more free cash flow per share. So we will continue to stay within the 30 to 40% or thereabouts through the cycle, but continue to create the capacity to be able to reward our shareholders as we have done in 2023 and as we hope to continue to do in 2024.
Okay, so you have the cash flow, you have the balance sheet. Many would look at that and say, you are ready, you are primed for more M&A activity. Do you expect to be more active this year when it comes to mergers and acquisitions?
Our focus is very much on delivering the first sprint that we announced. We are essentially just over 2 quarters into what is a 10-quarter sprint, and what we have identified is that actually the largest value opportunity for us is in just unlocking the full potential of this company. And so while we will continue to look at bolt-ons to our current portfolio, we expect to stay within the $22 to $25 billion capex range that we have guided to. And we will continue to look at preferentially going after buybacks. Because if I'm honest with you, Tom, the most attractive opportunity to allocate capital to in the sector, I think right now, is to buy back our shares at north of 15% free cash flow yield. And that is with a company that is actually building the momentum that we have. It's not a bad buy for us, and that's why we're focused on ourselves from now.
Okay, let me get your view on the oil price. We've seen gains in oil of about 7% through the month of January. There is this tension, it seems, between the demand question, whether that's softening, and the geopolitics. How do you see that evolving in the months and quarters ahead?
What we see at the moment is the market is well supplied. The demand has been remarkably resilient in 2023, despite multiple headwinds. The supply side is the bigger question at the moment. Questions around OPEC cohesion, questions around how sanctions might play up. You'll have picked up, of course, potential increase of sanctions against Venezuela and Iran, potential enforcement or tightening the enforcement of sanctions against Russia. All of that, I think, is raising questions around the supply side, not to mention the slight slowdown in the growth of the shales patch. All of that, I think, is just creating a bit more of tightening in the overall market, and we'll see how that plays out. But a lot of it will be based on geopolitics more so than anything else at the moment.
The gas trading desk, once again, knocking it out of the park, doing very well, putting a very good performance in. Is there anything that derails the strength that's coming through from the gas trading team?
I think the Q4 was indeed an exceptional quarter for our trading and optimization organization. We saw the opening of East-West arbs through the quarter, and we had length, as we typically do in the Northern Hemisphere winters. And that allowed us to take those opportunities and create real value. What you have seen so far this year, at the start of 2024, is the arbs aren't as wide as they were, so less running room there, and prices have come down. I think with fundamentals being reasserted now as you see a better storage balance in places like Europe and Asia and a milder winter.
How do you see the LNG outlook or demand outlook kind of evolving and changing as well, given that economies' growth is slowing, rates remain relatively high, the inventories are well filled here in Europe? What does the picture look like in terms of that demand for LNG?
So far, we're in balance from what we see, but the biggest determinant of demand growth, I think, will come from China and how China responds through 2024. Early signs are positive. While China hasn't essentially fulfilled what some people had expected coming out of COVID, they continue to grow, and we see the LNG import growth continue, in particular at these lower prices now that they are able to buy at these levels. And so that's going to be a big determinant. What's I think key in 2024 is there isn't a lot of new supply coming into the market. And so as you go back into stock refilling after the winter, I suspect you'll see robust demand. So for the coming year and a half, I think there'll be some good demand. I think one thing to keep in mind in the medium term is China, again, will draw a lot of gas. To give you a sense of that, just in 2024 and 2025, the volume of natural gas power generation capacity that China is building is equivalent to the entire installed capacity in the UK today. And that's just China's build out. So there will be a lot of demand for energy.
What is your reaction to this decision by the Biden administration to pause the build out, the licenses, the approvals for export facilities, LNG export facilities in the US? What's your reaction to that? Does it put any of your investment plans in the US at risk?
I think the short, medium term, there will be very little impact to the LNG markets. What it does is it undermines confidence, I think, in the longer term when it comes to US LNG, which is a real shame given the world demand for LNG is going to continue to grow, and the US is the largest supplier of LNG today. So a pause like this can always create more uncertainty, in particular when you're looking at long-term investments. That and, for example, the behavior of Venture Global in the US to not honor the contracts towards its off-takers, all of that just undermines confidence in US LNG at a time when the world, including here in Europe, really need the stability of LNG supplies.
That was the Shell CEO of El Sawan speaking to Tom McKenzie a little bit earlier on. The build-out in China and the role that China plays in the demand story around energy.
The President Biden just banned LNG exports at a time when this was supposed to be America's answer to the transition away from oil, and here we are undermining it, as he said.
They've got a massive contract fight in the States, so that's kind of one factor. So he's kind of talking his own book there. But I think the evidence is growing that Europe has made a big bet on the United States, and maybe the volatility that they didn't anticipate is going to be there.
Thankful for the storage at this time, I suppose.
Yeah, well, thankful.
And the Qataris.
The Qataris, and we've had a reasonably mild winter. What I think is, just if you take a step back there and think about the portfolio sort of story around energy stock, everybody was dissing energy stocks at the back end of last year. Everybody was underweight energy. That is now starting.
Inflation hedge, that sort of thing.
So that's starting to shift back now. People are putting a lot more energy back into their portfolio. So if you talk to strategists after strategists after strategists, they are, I keep seeing notes coming across my desk talking about the fact that we are now overweight energy.
Okay, let's get some individual movers this morning, and some of them are having a big read across into the full sector. So let's go to Joe Easton, who's got a briefing. Joe.
We've got a massive drop in Adidas as expected over in Germany at the moment, down around 8%, pretty much in line with what we saw in the US ADRs in the US overnight. This is two things. It's the Yeezy impact, Kanye West, those goods being sold at cost, and also the devaluation of the Argentinian currency is what's hitting those, and we're seeing the read across in Puma. We've already had a warning from them related to Argentina just a few weeks ago, and also a couple of declines here in the retailers, JD Sports and Fraser's Group, the owner of Sports Direct, both of those declining as well. We've got a bunch of other big movers to bring you. Firstly, in the banking space, take a look at those bank shares there. BNP and ING both down almost 9% now. Fixed income trading is the weakness. Also, net interest income generally coming off the peaks. So that is weighing on them. But we are seeing Deutsche Bank gaining today. Their share buyback taking the sting out of their weaker trading business, potentially the positive on that one there. And Julius Baer, an interesting one for me. This one actually gaining. We had the news of the departure of the CEO. They've taken that massive hit from their exposure to Signa, the Austria property company. But we're seeing the stock actually rising, potentially an end to that saga, maybe putting some positivity back into investors today. Then we're going to look at another one that stood out at the open there. We did see a headline. It's Volvo Cars up 20%, a huge move for that stock. It's related to one of their electric vehicle businesses and a deal with Geely. They're going to unload some of that stock to existing holders. Geely's going to put more money into that business, and as such, that return of capital via that deal is boosting Volvo, a huge gain, the biggest gainer on the stock 600 today. And you mentioned Roche earlier. Now, this is also a currency impact. It's the Swiss currency. The appreciation of the Swiss currency is weighing on that company. And also, they've had a couple of delays in some of their drug trials as well. So a double hit, but mostly currency related. Shell coming up, you mentioned that one as well earlier. They've got a big buyback. The oil price pretty much stable, stagnating at the moment, but that return of capital is helping that stock and helping the FTSE 100 a little bit today. And in the tech space, we've got Dassault. This is the software Dassault business over in France. Exposure to electric vehicles is weakening, and that is why they are guiding lower on some of their organic sales in terms of Dassault systems over in Paris. One of the worst performers, again, that we've got on the stock 600 at the moment. Then I just wanted to bring you a couple of rating changes that stood out. EasyJet, this one is a new overweight at JP Morgan. It's one of the cheapest airlines around at the moment, trading below some of its book values. JP Morgan sees value lifting that stock 0.9% at the moment. And next, this one is cut to equal weight at Barclays. They've been overweight the stock for 4 years, finally cutting that one to equal weight. What does that say about the UK high street? Potentially a weakening given the ongoing cost of living crisis, and that one is falling 2.6% in London.
Joe Easton from our equities team walking us through all of that. How we did that without taking a breath is beyond me. We thank you so much for bringing us those initial movers. But Anna, let's circle back to one of the topics here, which I think is being fairly undercovered, which is this commercial real estate story. How much of this are cracks emerging in the system that no one is seeing yet? Is this the black swan event that we were warned about 12 months ago and is kind of making its way back around?
It's coming back in, and it's interesting. It's coming back in, but in keeping with the macro story. So that we've got the real estate is the worst performing sector today on the stock 600, and this is post-Fed, isn't it? You know, you've got a sector that's very dependent on whether we get a cut in May or March. You know, matters to that kind of sector. So you expect to see that macro read across. But then there's also these really other fascinating stories. Julius Baer and its Signa exposure, not new, but it's having an impact. But the story out the States yesterday, the story around the bank call there, really fascinating, the exposure there. And we're talking about new businesses financing at higher rates, of course. Also property values coming down, return to work, all of that in the mix, and the sector just struggling in the higher rates environment.
So it's the rate story, I think, is really interesting because in some ways I understand why, and this is a sector that's had a bounce recently on this idea that rates are going to be coming down. So in theory, yes, I understand that that's positive. However, if you actually talk about the reality of what's happening is that a lot of deals will now start to happen as people get more visibility on what the rate environment is going to look like. So you can now start to get the sector moving. And when the sector starts to move, you start to get a crystallization of these lower valuations because you don't know what buildings are worth until you actually end up selling them, and then everybody else prices off those lower deals. So in some way, the rate stability, the rate coming down, frees up the sector, but then you start to take and get an understanding of the losses that are coming through. And I think maybe that's the story for 24.
But there's a big piece of it that I think we're not talking about. And I can't speak to Europe, admittedly, but I'll speak to the United States. When we talk about these divergences and these rates, for example, that you were saying, there is a big regional gap. If you were looking
New York is,
I mean, New York, California, we know those. Miami, we'll even call it. But then you look at prices coming out of, like, Seattle, for example, or Wisconsin, or some of the places where it is actually affordable to hop into housing and commercial real estate. And the gaps that you are seeing in this market are historic right now. And it's really hard then to get that kind of exposure when you're saying, well, is the return to office story still relevant? Is that still happening in New York or Miami? Or is it going to Austin? Is it going to, you know, wherever else in the U.S. might exist?
Yeah, well, certainly commercial real estate will keep very firmly in view as we watch how that unfolds in 2024. We're already getting some interesting warning signs. Coming up on the programme, we're going to be speaking to Jim Rowan, the Volvo Cars CEO. Yes, we've had numbers numbers out from Volvo Cars, but we've also had comment that, well, a decision that they are going to stop funding Polestar and may distribute shares, and this has had a really big impact on the shares. The share price of Volvo Cars popping really strongly this morning. We will get to that conversation shortly. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because this is really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see you've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
DOJ or other authorities
Could face bigger challenges next.
Fed was going to keep rate World Cup.
This is a 3 as the economic picture does.
The BOK is getting ready to make.
Volvo Cars share price surging this morning. It's got nothing to do with the numbers they've announced. It's all to do with the fact that we are going to see a reallocation of shares in Polestar, which is the electric EV company that was spun out of this business. It listed, and analysts have been calling into question the valuation. The stock is up really strongly on the back of the fact that it looks like Geely is going to be effectively taking over that business, taking the pressure off Volvo Cars. Jim Rowan is the Volvo Cars CEO. He joins us now. Jim, good morning. Look, we'll talk about the numbers in a minute, but the market reaction this morning is very strong. There was serious concern about the valuation around Polestar and your stake in it. Was it a mistake to list that business in the first place, do you think?
Well, listen, as I say, I'm an engineer. I'm not an archaeologist, so I think you can look backwards and make up your own mind on that. But the bottom line is that for me, this is a natural evolution. We were a great partner, I think, as we incubated Polestar as a business, as we helped share that technology, as we helped get those first cars into production. And now Polestar, I think, are in a really strong position. They go from a one-car company to a three-car company. They're using both Volvo technology now and Geely technology. And it seems natural that this is the time for them to spread their wings, to go and get their own funding. And for me, this is a good thing for Polestar. I also think it's a good thing for Volvo.
Good morning to you, Jim. How much of Polestar's issues are down to Polestar, and how much are they down to sluggish demand for EVs more generally?
Well, when I look at sluggish demand for EVs, I look at our own numbers. We're 70% up on EV sales year over year, and we're seeing that tremendous growth in most of the markets around the world. I think the EV market is bifurcates into mass market and also premium. And premium, where people own their own homes quite often, where they have their own home charge infrastructure, we see a huge amount of uptake in our EVs. What we actually see is people who will enter the electrification through their plug-in electric hybrids and then migrate to full EVs over time. So I'm still bullish on EVs, but I'm also bullish on the fact that we have a very strong plug-in electric hybrid and even mild hybrid bridge to full electrification.
Jim, it's Creedy in London. Talk to us a little bit about the affordability story. It's not a secret that Americans don't like to touch electric vehicles, mostly because they are still far too expensive. They're still considered a luxury relative to their gas-guzzling peers. How are you addressing that? How are you making your cars cheaper?
Yeah, when we started the EV journey many years ago, I think 2018, we brought out probably the first EV car. We started to address that problem right there and then. And so we designed the EX30, which has just come into sale now. The EX30 is a small, affordable SUV, and we'll sell that car for $35,000. That gets us, and we'll also be able to deliver a 15 to 20% gross margin on that price point. So that tells us that we've already crossed the Rubicon. We've already figured out how to provide ICE cars and BEV cars at the same price parity.
Jim, final quick question. I just want to get your take on what's happening with the macro picture right now. You've had issues with the Red Sea. Your supply chain has been impacted by what has been happening there with vessels having to go around the Cape. Can you just talk me through what's happening right now? Just give me an operational update. Are you still experiencing problems with that? Has that now been resolved? If this situation continues, how are you going to manage around it?
Yeah, it's not a huge disruption for us. Considering what we've dealt with in the last couple of years with COVID and semiconductors and so on, this is a minor blip for us. So it costs us some weeks in terms of having to ground the Horn of Africa. But by and large, we've now got those pipelines primed. It won't be a big consideration for us, I think, going forward in terms of customer deliveries or in terms of costs. And so doing that again really helps us. Coming off of a record 2023 in terms of revenues and profits, we think we're set up now, even with some of the supply chain disruptions, we will be set up and we've guided that we expect to have another record year in terms of revenues in 2024.
Okay. Jim, thanks so much. Jim Rowan, Volvo Cars CEO, joining us there on a day where the share price has really popped as a result of what they said about Polestar. You come into a morning with a set of thoughts in your head, questions to ask a CEO that are all very much about what are you going to do about Polestar and all the money it's taking.
Resolved.
And it's resolved in one fell swoop.
It's resolved in one way. Geely's basically taking on the issue. You do wonder where the value ultimately lies in this business. There's plenty of analysts out there at the moment that subscribe no value to that business.
I still have so many questions on the price story. I don't know how you address that now that that's coming up. Of course, we're going to talk about that on the broader story coming up on the program. Looking ahead to the BOE rate decision, 12 p.m. London time. Stick with us. This is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime. But we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising New York
the
City?
mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg.
This is Markets Today. We're about 30 minutes into the European trading day, seeing a little bit of a mixed picture when you look at what these individual stocks are doing. The stock 600 virtually flat at the moment, but really is a sum of all parts trade. I would say the focus is all about the macro as we get a Federal Reserve decision, kicking the can down to what the BOE says. Anna, Guy, we talked a lot about the corporates. Let's zoom right back out. Does the BOE send a similar message to Jay Powell?
Maybe it also gives the Bank of England maybe time a little bit to think about what it's going to do and maybe digest the news that it's got from Powell. It maybe gives it a little bit more breathing room. Actually, let me just focus for a moment on what's happening with the single stock story. The banks, I think, are fascinating this morning. There was a really interesting bank story out yesterday from New York. New York Community Bank called down on the back of the story surrounding what is happening with real estate. But this morning, you've got a real compare and contrast. Deutsche is leading the banking sector. It's up by 4%. The numbers are okay. The buyback looks like it's kind of swayed everybody.
Yeah.
BNP Paribas at the other end of the spectrum, right down at the bottom of the banking sector with ING. BNP is down by 8%. ING is down by circa 8%. So we've spoken to the two CFOs. So let's do the compare and contrast. This is what they both had to say. You can listen to what they both have to say this morning in the interviews we've done with them.
If you look at the indicators that what I see from the European front is on one hand, you see inflation tapering off. On the other hand, you also see the economy somewhat tapering off. So these are all kind of indications that could be a trigger. What I think that the European authorities are looking at is what is going to be the impact, and particularly on the wages. So you have some indicators that are a trigger to act. I think there will be this need to see, in particularly, how wages are evolving in order to see when it will happen.
Fixed income and currencies for us at 1% up on last year, which was a strong, fourth quarter, was actually encouraging. And to your question, momentum is carried through into 2024. So we've had a strong January, and we also, if you like, think the environment now, finally, after 2 years of going backwards, should be much more conducive to corporate finance activity.
Okay, that was the CFOs of Deutsche Bank and BNP Paribas. BNP Paribas talking about the macro backdrop, but I think it's been some of the misses that they've had in particularly in their trading, plus also some of the provisioning, which Lars tried to put a sort of positive spin on. Deutsche's trading, they're talking about maybe corporate activity replacing trading actually going forward, and they've had the buyback. That's why you're getting the big difference maybe in the share price performances this morning. Deutsche is up by 4%.
Yes.
Paribas down by 8%.
Divergent, isn't it? And ING is certainly a weight on the sector as well. That's one we need to mention, down by 8.6%. And this has a big macro theme in it, Chrissy, because this is about net interest income falling because the boom they got from rates is fading. And this is something that we're going to see across other parts of the banking sector, and we ask more questions about into 2024.
Yeah, we should mention we had Santander on yesterday as well, who said something similar, that they are actually so diversified and so positioned. This is actually one of the prospects that Citi has actually outperformed some of its peers over in the United States because of this idea that they were able to kind of carry up the net interest income around the world and not just in the G10.
It's the only real U.S. global bank, isn't it?
It
with
is.
That kind of a footprint.
It is, but the U.S. global banks, JP Morgan, Goldman, they've been riding that trading volatility for so long, and that's where the deal volume, even though you've seen deal activity completely collapse, they haven't felt the hit.
Yeah. Here's the thing. I'm a bit distracted by the Riksbank this morning because we're getting some great headlines.
You don't often hear that kind of a sentence,
you don't really. We're getting some headlines coming across here, but what interests me is the link between real estate, a subject we've been talking about this morning, and what Sweden is doing on their interest rates this morning. So no change, fine. That was what was expected. But they say that the policy rate cut in the first half of 2024 cannot be ruled out, and they also point to the fact that, well, and they very explicitly say that the rate cuts could come sooner than was indicated in November. And here's an example of a central bank that's struggling with the property story and having to act on rates. And we've been asking whether that's going to happen more globally.
Yeah, and what I love about this is that what lessons can then the Fed, the BOE, et cetera, learn from these kind of micro stories in Sweden, among others. Let's go, though, from Sweden right back here to the UK. We, of course, have that BOE rate decision coming up. Bloomberg's UK correspondent Lizzie Burden is all over. Let's go to her now for a little bit of a preview. Lizzie, walk us through what we're expecting shortly.
Well, the Bank of England is expected to hold rates today. So the question, as you've been asking, is when does it cut? And there are many critics who say the Bank of England should not be in the business of forward guidance. It only opens the door to them being the unreliable boyfriend. But markets are pricing 4 quarter-point cuts this year. And the clues that could change that outlook today will come, first of all, from the vote split. Do you see Swati Dhingra, the dove on the committee, actually voting to cut today? If you look back through history, it would suggest that it'll only take 2 meetings for the majority of the committee to follow her. That's if you look back at all the past 14 changes in bank direction since the Monetary Policy Committee's inception back in 1997. But at the other end of the spectrum, our economists reckon you could actually have a 3-way split, and the hawk on the committee, Catherine Mann, voting to hike rates because you've got persistent wage growth, stubborn services inflation, and all the disruption in the Red Sea. So any vote to hike would make the Bank of England a bit of an anomaly internationally. Now, the second clue that I'll be watching is the guidance. Do they move away from this hawkish bias? Do they stop talking about the need for further tightening, the need to remain restrictive for an extended period? Because if they don't, it could be seen as the Monetary Policy Committee giving a bit of a rap on the wrist to the markets for getting ahead of themselves in terms of the rate cut bets. But if you have a Bank of England today that's seemingly allergic to rate cuts, and then you have a load of loose fiscal policy, because don't forget, it's an election year, even if Jeremy Hunt, the Chancellor, says he can't afford tax cuts, he said that last time. Well, PGIM and Goldman Sachs reckon that the pound could go to $1.30, and we haven't been at that level for a sustained basis in about 2 years.
Lizzie, thanks very much. Bloomberg's UK correspondent Lizzie Burden giving us a briefing from outside the Bank of England. Let's get a really expert view now on what to expect from the Bank of England. We're joined by Charlie Bean, former Deputy Governor of the BOE, of course, on set with us here in London, now Professor at the London School of Economics. Really good to have you with us. Thank you very much, Charlie, for being here. So the vote split is getting quite a bit of attention, and I suppose it's because we're in a situation where markets are talking about and expecting cuts at some point. The bank doesn't want to talk about that yet. And if you look at the vote split, the split was yes for a hold last time, but also with some dissenters calling for a hike. So there's a lot of ground to cover, it would seem, from going from the vote split we had last time around to reflect where the market thinking is right now. How are you looking at that vote split?
Well, the first thing to be said is that sometimes the vote split provides a useful signal of how the balance of the committee is moving, and sometimes it doesn't. So you have to be a little bit careful there. What we're talking about here is potentially individuals on the margins of the committee, either side, Cathy Mann, Swati Dhingra. It might well be a 3-way vote, but the real issue is the mass of committee members in the middle, what they're looking at and how soon they're likely to change their assessment
But
of what's going on.
But if you see even one member of the MPC voting for a cut, if you see that, then the Bank of England can't argue that it's too early to talk about cuts, can they? Because then there must have been conversations about cuts happening.
What is certainly true is since the last monetary policy report at the back end of last year, there's been some downside news on the prospects for near-term inflation. So inflation outturns surprised significantly to the downside. Also, we've got lower energy prices. But the real issue for the committee is not what's happening to inflation through the first part of this year, when it's quite possible that inflation might dip below the target, but inflation out in the medium term, 1-2 years ahead. And a key determinant of that is pay growth. So the thing I would expect they will have spent a lot of time discussing in the committee room this time around has been prospects for pay. They have extra information on pay settlements. Pay settlements are concentrated in January and April. They carry out a survey of the bank's agents' contacts every year at this time of year to try and get a read on what's happening. There's an internal database of pay settlements. What information there is available outside at the moment suggests pay settlements are running at round about 5%, which means if you allow a bit for wage drift on top of that, it doesn't imply much deceleration in pay growth from the sort of 6% number, which is way above what's consistent with the inflation target. So I would expect them to be signaling the importance of pay and also conveying a note of caution about rushing into the idea that rates will fall soon.
Okay, Charlie, you teed it up nicely. If you were still there, if you were sitting on that committee, when would you be voting for a rate cut? When do you think it's going to come?
I would be avoiding saying that. Forward guidance was a necessary evil during the aftermath of the financial crisis when rates were at rock bottom. No central bank has a crystal ball, so it's really dangerous to get into time-dependent forward guidance.
The problem, I understand that. The problem is, though, that you get an effect through the markets. The market sees something. We're seeing it in the States. You're seeing it in Europe. The market sees what's happening. Financial conditions loosen up. Mortgage rates are already coming down fairly rapidly. And you already start to get the effect being priced into the economy. Does the bank, therefore, need to push back against that in the way that Jay Powell did maybe last night, suggesting maybe then actually hikes come a little bit later? Because the effect starts to be manifesting itself in the economy before you get the cuts coming through.
I think that the real key thing is that the Bank of England and other central banks ought to be focusing on what are the key issues that are going to determine our future rate decisions. So pay, the rate of growth as well. I don't think there's any evidence that the UK economy has slowed down or sped up relative to last year. It looks like it's continuing to flatline, but that would be something else that would be relevant to their rate decisions. But emphasizing the things that they're looking at then enables the markets to respond when they see the data coming out, because that's ultimately the thing that will determine the bank's decisions. Now, it's perfectly reasonable to take the view, well, the labour market has loosened somewhat because of the decline in headline inflation that we're seeing. That might lead to some slowing of pay growth further down the road, which will allow some a decline in bank rate. But it's, I think, very unwise to be tacking dates to that and saying, how many cuts this year. There'll be something in their central view on which their forecast is predicated. But the key thing I think they need to emphasize is the uncertainty around that.
But that's the story you heard in the States as well, where basically this was all tied to the labor market. That is no longer the story because it's kind of been established that the labor market is too strong. You have the opposite problem here where pay growth isn't getting stimulated in the same way. To what extent does that get in the way of changing policy, or is that still the sticking point?
Oh, for the UK, it's really key. There is no way that 6% earnings growth is consistent with meeting the inflation target, given our productivity growth is so weak. That's consistent with inflation settling at something like 4% in the medium term. What the bank will need to be confident is that pay growth is coming down to a level which is consistent with meeting its 2% target out in the medium term. And that's a message I think they need to be reiterating. It's not an exhortation for incomes policy or anything like that, but it's simply a statement about what it is that drives their interest rate.
The governor has gotten a little bit of hot water recently as well. Not that recently, a little while ago, when talking about wages. So maybe he's a little bit reticent. Charlie, we've got to release you. Our good friends and colleagues over at Bloomberg Radio are going to be carrying on the conversation. So if you want to carry on hearing what Charlie has to say, and who wouldn't, he is going to be joining Bloomberg Radio. Charlie Bean, professor at the London School of Economics, former Deputy Governor over at the Bank of England for Monetary Policy. We're going to have some great coverage coming up. We're not done yet with the Bank of England. When that happens, when that decision happens, we'll obviously cover it. Bloomberg Surveillance team will be covering it there. I'll be in the chair a little bit later. We'll take you through the press conference. We're going to bring you a conversation as well that I think Francine's doing with the Bank of England Governor, Andrew Bailey. That's going to be at around 4 p.m. Roughly 4 p.m., depending on the edit it is.
Yeah, but plenty more on the program as well. Coming up, EU leaders meet in Brussels in an attempt to find an agreement on a vital 50 billion euro aid package for Ukraine. That conversation next. Stick with us. This is Bloomberg.
Capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Discussing this with other leaders, and let's see how this meeting works out. Because if every time something is offered, then this pattern will continue. Because you get something out of this I don't want to use the word blackmail, but I don't know another better word.
That was Estonian Prime Minister speaking as the EU leaders meet to discuss the vital $50 billion euro aid package to Ukraine. Bloomberg's Maria Tadeo joins us in Brussels to walk us through a little bit of it. Maria, walk us through what's at stake today.
Look, it's 50 billion euros for Ukraine over the next 4 years. We know this year alone, Ukraine says they will need around $40 billion. The effort, the impact on the war is clearly significant on the economy and is draining resources from Ukraine. So obviously they need to turn to international partners, the European Union being one. As you see, today we have a summit going on in Brussels. It has not officially started, as you say, but the way that this is happening and is being framed is this is now 26 countries versus one. This is 26 European leaders held back by the Hungarian Prime Minister Viktor Orban. Now, some of the prime ministers and leaders that we've spoken with this morning suggesting there's an element of blackmail here. When I spoke to the Polish Prime Minister Donald Tusk, he said if we do not get a deal today, Viktor Orban will be responsible for, quote, a very dark scenario for Ukraine. Having said that, there is a meeting, we understand, that is happening now behind closed doors between the French president, the Italian prime minister, the German chancellor, the head of the European Commission, and Viktor Orban to try to broker a deal. Perhaps is that meeting that's going on right now behind closed doors that will make or break this deal.
And Maria, talking about Viktor Orban and how far he pushes the EU, last time we caught up on this subject, you were talking about the ways that the EU was basically trying to cut him out of various processes. What's the latest on this relationship?
Well, Anna, that's a very good question. In fact, over the past week, we've really seen a dramatic change in tone from European leaders. If you remember, just up until a few months ago, there was always this idea that you have to work with all leaders, this idea that some of his concerns may be valid. Some of that language has really changed over the past week, now seeing that a lot of this is not acceptable. There's also the idea, and I put this question too to the Polish Prime Minister, about the respect of European institutions, the dignity even of this House. What happens if this becomes an entrenched dynamic where every meeting is held back by the same person? Is that acceptable to 26 other leaders that have been democratically elected for a different agenda in many ways? But so far, I should note, Viktor Orban has not spoken to the press. This is very unusual. We know he loves the camera. He loves the attention. We have not seen him. We know he is taking a meeting behind closed doors with a number of leaders, including the French president, as we speak. But yesterday, he did reach out to farmers. There's all around here, I wish you could see it, farmers that have really blocked some of the roads, tractors. This is a different protest, so to speak. Now, Viktor Orban trying to present himself as a man of the people, but it is interesting that back home he never meets with critics. But in Brussels, he was willing to go to a protest yesterday.
Okay, Maria, thank you very much. Maria Tadeo in Brussels flagging this protest activity that's taking place very close to where those EU leaders are meeting. Of course, farmers in protest has been a theme over recent months in Germany and France, and there in Brussels as well. Sticking with the subject of Ukraine, coming up at 9:40 UK time, an exclusive interview with Ukraine's finance minister as time runs out for the EU to strike an agreement on aid for Ukraine. So stay with programming for that. That a very important part of the geopolitics that we're dealing with right now. Back to where the markets are and what the markets are thinking about. We've done quite a lot of justice to a lot of the central bank conversations. Always more to say on that. But there's plenty to look ahead to when it comes to tech as well. We haven't even mentioned Apple, and the list of issues for Apple is long, isn't it? From Chinese restrictions on their technology to antitrust scrutiny in Europe. We've seen them having to change the way the App Store works, for example. Vision Pro, giving them a headache even before they put the headset on.
And they don't have an AI story. So where's the AI story? You've seen that impacting all the other stocks. Apple is the one that feels like it needs to do something on that front.
Yeah.
So when does that happen? What does it look like? Do they need to buy that technology in? I'm fascinated to see how that works, because we talk about the Magnificent Seven kind of being similar. They're not.
Yeah.
They're very different. And Apple increasingly feels like a hardware company
and risk of
right
disappointment on such mega caps.
Yeah. Well, to me, I think it's Amazon that's the story. And there was a really interesting note coming out of the Bernstein desk as well that actually talked about the fact that when we're talking about the AI story and the cloud story, Apple, to your point, matters a little bit less. It's the Amazon story because they're the only ones who are equipped with those cloud services in the same way that Microsoft is with Azure.
Yep.
Amazon Web Services actually has the ability to capitalize on it. Do they, though, is the question. And does that then help Amazon?
And how much do they need to spend? So it's just basically at the moment it's access to two things, one of which is chips, and the other one is power. And both of those two issues are throttling this back at the moment. So you're having to pay up for both, and you do wonder whether the cost to make the AI work may be so high that actually some of the benefit gets significantly eroded. So I'm really fascinated to see how that dynamic works as well.
One of the big themes that's been running through this program, and we've explored it from different directions, has been real estate. We see, of course, the developments in the US yesterday, really interesting stories around where the pain in real estate falls, and we've seen one example of that in the US yesterday, and that was a really well-read story on the Bloomberg terminals. There's a lot of interest in where those cracks are in commercial real estate. Then we saw that transferred over to a Japanese bank today, suddenly popping up with a warning on the back of commercial real estate in the United States. And then back here in Europe, Julius Baer has been the poster child for issues around real estate, along with the Swedish economy. And then we get that guidance from the Riksbank.
The linkages here are going to be fascinating. Think about it. Korean pension funds, massive investors into US property. How does that translate back into the Korean economy? I don't think we fully understand yet how all the connections are going to work on this. That was certainly a takeaway from 2008, that when you see significant revaluations of assets, you don't know where the ultimate holders of those assets are, and where the pain is going to be felt, and how leveraged it is.
Yeah, absolutely. And some of the opaque structures around certainly the European story around real estate mean it's difficult to work out where that exposure is. And the other thing from the GFC that you realised is that some sort of level of understanding of accounting, and when you actually have to reflect in your numbers those values and the change in those values, that's really important.
But can I just say, these are all corporate angles. We haven't actually seen it shown up in a big way in the economic data just yet. Even if you look at the Empire Manufacturing Survey, for example, there's a drop, but it's not that substantial of a drop to say this is going to be the next collapse in the U.S. and around the world. And that's the part that I'm waiting. When does it show up in the eco data?
Yeah, well, resilience last year was such a theme, wasn't it, in the United States? I mean, next week we get the ISM services out of the U.S. And remember, that was an area of weakness, wasn't it? But I mean, manufacturing has been bumping along the bottom for quite a long time as a global theme. And when you really start to see some kind of capitulation on the services side, I suppose, is something to watch for.
It absolutely is. But and to your point on the manufacturing side, it's actually so interesting because even though the data has been, to your point, kind of fumbling along, it's the staffing, it's the productivity, it's the capex investment in that sector. You look at the big industrials coming out of the U.S., and that's where you're seeing the pain points. But again, you're seeing it through the corporate angle and less through the data.
Okay, so day ahead, what does it look like? We've had a whole bunch of European corporates that we've had to price in. We've dealt with those. You've seen some fairly big sort of reactions, particularly in some of the European banks.
Yeah, still post-Fed reaction as well, aren't we?
You're having to price in the Fed reaction. We'll price in the Bank of England a little bit later on. Then a little later, we're going to return to the technology story.
Is that what that is, though? Is this a post-Fed reaction? We saw a big drop in stock market.
On real estate, a little bit. You know, there's an exposure to rates. And, if the rate cut in the States isn't coming until May, and you previously thought it was March, then maybe at the margin there's some impact.
In the equity story. But in the bond market, it's a different one. To me, what caught my eye was the 10-year yield now substantially below 4%, 3.93. It hasn't broken that level in 6 weeks.
Where you didn't get a big reaction in the bond market in the same way that you got in the equity market. So the equity market yesterday felt like it was reacting to tech as well as the Fed. The Fed was just a kind of augmenting factor.
Yeah, it pushed in the same direction as that theme, didn't it? Because the earnings were weak out of tech, and then you get the Fed move as well for a sector that cares very much about the Fed, and all of that matters. Okay, that is it for this couple of hours. It's been busy. Thank you for being with us here on Markets Today. The Pulse is up next. They'll continue to take you through all of the impact of these earnings stories. They'll also get back to the geopolitics, an important interview on Ukraine coming up. We'll also have plenty of coverage of the Bank of England on Bloomberg TV. Stay with us for that. This is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. and they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. And market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Jay Powell says a March rate cut is unlikely, even though the tightening cycle has peaked.
I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that, but that's to be seen.
Well, the Bank of England's next up with expectations of a cooler inflation forecast, potentially opening the door to guidance on easing, plus earnings in focus. BNP Paribas slumps as it cuts targets and fourth quarter profit falls. Deutsche Bank rises on planned cost reductions, which include 3,500 job cuts. So there's a lot going on today. Happy Thursday, and frankly, good luck for the rest of the day. This is what the European markets map is showing right now. So you can see, for example, the FTSE gaining some 0.4%. Now we had Shell, 1 billion more in terms of earnings for the quarter. That was much better than expected. We've had a bit of a mixed bag when it comes to some of the earnings. Adidas and BNP Paribas under pressure. That's dragging the DAX lower 0.2% for Adidas. BNP Paribas, I think, down more than 8.5%, and that's putting a bit of pressure on the CAC 40, down 0.6%. The real focus, of course, is on exactly what happened, what we heard from Jay Powell, the fact that there was a pretty significant pushback against that March rate cut. What does that mean going forward? It's very clear that the next move is a cut as expected. Is it not March? When is it? And again, there's a bit of repricing. Investors really looking through what would also that is where that means for the ECB and the Bank of England, which is later today. And then finally, later on, we have a lot of big tech companies. Again, that will give us an indication on whether the Wall Street rally was justified or not. Now, let's get more on the earnings. Let's get straight to Justina Lee from Bloomberg. Justina, thank you for joining us. I mean, earnings, it's kind of really a mixed bag. Some are great, some are really bad. BNP Paribas down 8%.
Yeah, exactly. And I think banks really are the focus today. I mean, with BNP, they were hit by, the end of a payment from the ECB on their reserves and also legal provisions. So there's some issues kind of idiosyncratic to it. And then, Deutsche Bank, on the other hand, was lifted by kind of expectations of our shareholder payout. But I think a lot of people will be thinking about the fact that we're kind of in this shifting economic regime here where you're not going to get that boost from kind of that high interest rate anymore. And at the same time, the European economy is possibly also slowing. And of course, we also got a string of bad news from U.S. banks overnight about their commercial real estate portfolio. And so you're kind of really seeing a lot of signs there that there may be more pressures on the banking sector.
Justina, very quickly, I mean, it doesn't seem, cost cuts don't seem to be at the upfront of, you know, chief executives' minds like they were last time around.
Yeah, I mean, that's kind of interesting. I think a lot of people are trying to see, you know, where consumer demand is going, where the economy is going. I mean, interestingly, you know, today, like Adidas is slumping this morning, you know, because they're forecasting profits is going to be half of what analysts are expecting. Now, that's partly because of a currency hit, but I think that's kind of also making people think about, you know, demand from China, especially for kind of all these consumer goods.
Justina, as always, thank you so much for joining us. Justina Lee there with some of the main earnings that we saw. Now, we're joined by Karen Ward, Chief Market Strategist, EMEA at JP Morgan Asset Management. And what a day, Karen, to come in, because there's a lot going on. I wonder whether that, you know, the pushback from Jay Powell kind of changes everything.
It does. I think what's really important is that what was so wonderful about December that we got from Jay Powell was the idea they were going to be preemptive rather than reactive. And that's really important for investors in risk markets, because if they're going to be preemptive, they're going to see off any risks for us of slowing economic data, of slowing corporate earnings. So the market loved what he said in December. Yesterday's tone was a little bit more reactive. It was still waiting to see whether the economy really is slowing, whether that moderation in inflation is genuine and sustainable. So to me, I think that switch, the market did get carried away in December, and it was a reality check yesterday. And he was right to do so. I think he was right to be a little bit more hesitant.
And Kerry, here's Jay Powell from yesterday.
I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that. But that's to be seen. So I wouldn't call, you know, when you ask me about in the near term, I'm hearing that as March. I would say I don't think it's probably not the most likely case or what we would call the base case.
Karen, is there going to be a bias, I guess, for most central banks that actually they just want to make sure that they don't have to reverse course? So, you know, if all things being equal, they'll probably cut a little bit later just to make sure that inflation's really down.
I think they should. I think that's what they should be doing. I think, as you say, they've worked terribly hard to bring headline inflation down, to anchor their credibility. I think to move too early, we've seen historically that actually preemptively before you're absolutely sure that the underlying pressures, and there's too much emphasis today on headline inflation. Yes, headline inflation went up today to 8. It may come down to 1, but we need to look through that. What's the sustained underlying rate of inflation in the economy? That's coming from the labor markets. The labor markets are still pretty solid. Unemployment's still record low in most places. Wage growth is moderating, but not in a way that's consistent with 2. So I think they're absolutely right to take their time, because the data are not crumbling. And in fact, what's happening, Francine, is with wage growth being a little bit sticky because the labor market's okay, and headline inflation falling for what I would say are transitory factors, that's already a boost to the economy. And I think what you're going to see is consumer spending possibly re-accelerate. There's a stimulus coming without them intervening. So to wait and see how that whole narrative plays out, I think is the right thing to do.
I mean, at the same time, so you have geopolitics. It just feels like a funny 6 months that markets need to decide what will support valuations.
I think that's right. And as we get to the second half of the year, the political events, I think, are going to take precedent in terms of decision making. But I think this is just, you know, what I would say at the moment, and certainly what I'm saying to clients, is just don't be cute about our ability to do this. You know, the inflation data all over the show. What are the solid longer-term themes? 4% on the US 10-year, these bond yields on high-quality bonds. This is a good level. We know we're past peak. Lock that in. Stay quality-focused across the spectrum, because there's still a lot of uncertainty.
Bank of England. I mean, the governor can't really catch a break. There's a lot of pressure. He's getting criticized a lot for being behind the curve. Are they?
Well, the bank are just in a very different position to the Fed. I mean, the Fed, again, let's forget what's happening on headline inflation, because in both regions it's improving. But let's focus on what's happening in the labour market. The Fed have got 4% wage growth with 2% productivity. So there is not, you know, huge inflationary concerns coming from the labour market. We need to still monitor. The Bank of England has got 6% wage growth and 0 productivity. It's got a totally different configuration of underlying pressure. I think the real challenge to the Bank of England is how it sets out a framework today for guiding not just markets, but the public. Because, of course, if interest rates come, if the inflation rate comes below 2, the public's going to say, well, where are my rate cuts coming? But if it's not the right thing to do, so I think setting out a framework early doors where they say, look, we looked through 10% inflation. We didn't take rates up to double digits when inflation was 10, because headline inflation is not what we should focus on. We have a medium-term target. And just in the same way, we'll be looking through any transitory downside. But they need to set out not forward guidance, that always gets them in trouble, but the framework, I think, is what they need to set out today.
But Karen, how much of this inflation actually reduction is thanks to the central bank? I mean, is it almost impossible to quantify, or are they just lucky? And so then all of those rises are leading to what?
So again, it's how do we abstract from the headline noise, which gets thrown around by energy, by supply shocks, and is still very much being thrown around by those factors, versus what are the really useful traffic light indicators of whether the economy is over capacity. And that's where I think we're getting into the more service sector parts of the inflation basket. But to me, the anchor is the labour market. The labour market tells us whether we are truly hitting the buffers of our economy, whether we have no choice but to slow. So that's where I think the attention should be.
I mean, there's so many things that could pull markets. What's your kind of base case for the next 3 months?
Inflation is still everything. Look, this whole rally that we've seen through the course of last year, but really intensified through the end of the year, is very much based on this idea that inflation is going to go away on its own accord without any need for slowing activity. That recession that was expected is no longer required. If inflation does prove sticky in those core metrics, then I think that whole premise of the idea these economies don't have to slow, that crumbles, and that's where we're going to get, more of a reality check for risk markets. So inflation is still everything.
Karen, I mean, there's a line of thoughts, especially for Europe and the UK, in saying, look, they're being crushed by the US. We don't know what happens with the election there between China, and this is probably the next 2-3 years where they get their act together, strengthen the supply chains, and actually have an energy policy. I mean, are you positive Europe, or are stocks, frankly, cheap for a reason?
I am positive, actually, relative to expectations, which is always the critical thing. And I think particularly we underestimate the role of the establishment of the recovery fund, which a lot of those grants still haven't been dished out yet. And basically what's happened from the sovereign crisis to post-pandemic is Europe has now moved from a very sticks-based cohesion policy to a carrot-based cohesion policy. And I think that really changes the political dynamic. And I think also we'll see some of the fruits of that activity. Look, we just had a Q4 print, and who were the great performers? Spain and Italy. Who are getting the biggest grants from the recovery fund? Spain and Italy. So I still think the growth trajectory is going to improve. I think we are past the worst in Europe, actually. I think consumers got a bigger cost of living shock. That's fading. And therefore, we're going to see a little bit of consumer improvement. And we're going to have our fiscal boost in Europe this year, whereas the US did it. The US has spent their growth in fiscal and in pent-up consumer spending. Ours is still to come. So I think expectations are too low on Europe, and that record discount between Europe and the US, even when you make adjustments for the different sectoral composition of the benchmarks, now to me looks too low.
So where do you want to be fully invested? I mean, if markets are priced to perfection, how do you actually play some of the themes that we've just discussed?
I still think quality bonds is very high on my preference list at the moment because, at these yields, we are past peak rates. That's something I feel I can say confidently. Yes, there's a question of timing, but you're now getting 4 to 5% on quality fixed income. I think that's very attractive. And then really using the dispersion within benchmarks and within regions, because that's where, certainly with investors over a 2 to 3 year horizon, I think that's where you're going to see the biggest upside.
So good. Karen, thank you so much for joining us today. That was, of course, Karen Ward, Chief Market Strategist, EMEA at JP Morgan Asset Management. Now, much more to come. This is Bloomberg.
product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Now, the Bank of England is likely to deliver a brighter outlook for the UK economy, reducing its forecast for inflation this year and potentially opening the way to interest rate reductions that could actually boost growth. Now, stay with us for the BOE decision when it happens. And for viewers in the UK, we'll also have a special coverage of the news conference. Later, we'll also bring our conversation with the BOE Governor, Andrew Bailey. That's at 4 p.m. London time. Coming up, our exclusive interview with the Italian fashion billionaire who's behind labels such as Diesel and Maison Margiela. We'll talk luxury demand in China. And this is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because this is really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're
we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back, everyone. Now, luxury stocks have mostly held their gains from the rally last week, triggered by robust sales at LVMH. Analysts now weighing up if the year ahead for the sector could more be positive than expected, despite inflationary pressures. Now, China, of course, remains a crucial market for European luxury, and my next guest opened a new shop in the country almost every week in 2023. Lorenzo Rosso is an Italian fashion billionaire and chairman of Only the Brave, OTB, the holding company that owns a range of brands such as Diesel Jeans, which he founded, Maison Margiela, and of course, Jill Sander. He joins me for an exclusive conversation. Lorenzo, so good to speak to you. Thank you so much for coming in. So
very happy to be here.
You're building this powerhouse of a lot of the brands. How are you seeing luxury demand going?
The luxury is great. The luxury is fantastic. The luxury is the most beautiful things in the fashion industry, you know. And the luxury also, I love luxury because in luxury you have the margin to running the modern brands today. Because in luxury, thanks to the margin, you can do a sustainable company that today is a very important. Because the sustainability are one of the most important things for the new consumer. If you are not sustainable, you cannot be a brand for the future.
But Renzo, I guess the concern is that some brands are doing very well, others not so well. So how do you create desirability? And is it the U.S. consumer? Is it the Asian consumer that is spending more?
You know, fashion is beautiful because you have a possibility every 6 months to prove that you are alive. And I think the brands that I represent on my group, TV group, Margiela, Jill Sander, Marni, and Diesel are very special because we're still really working with the beauty of the product. And we are very proud because the industry is going, the big industry is going in a different way. They try to be more entertainment, to be more community. That's great because they generate a lot of business, a fantastic business. But I go exactly in the opposite way. I still thinking I love my consumers, so I think to protect them, I think is nice, really working just with the product and give them the possibility to choose what they like and not just because they are part of a community.
So, Renzo, and I know you spend a lot of time also with artisans and trying to, you care about the made in Italy, but can you actually increase your prices? Or if you increase too much, does that hurt demand?
Well, prices are already very expensive, so now the market is looking for to be a little bit safer regarding the prices. Even also the big brands, I think they have to reducing the prices because they are too high. So the young consumer can be very difficult for them to approach to this couple of these brands. And what we're doing, we're working just with in a simple way, cost plus the percentage to run in the industry, and we're doing the best that we can. But we have to keep it alive, the brand with many things. Special, first of all, the beautiful of the product. Second is the sustainability, and we love the way that we communicate because we are much more. We're looking for creative dreams, creative desire that today is quite difficult to have in the fashion industry when you have everything.
Are you looking to IPO at some point?
Yes, looking for, because IPO can give me the possibility to run even more transparency, but for other reasons, for important reasons, also for the new generation that is going to bring my children, they want to bring the companies. And also the third reason is that for me, really, I love very much to have all people working for me that they can be my partners.
So, I mean, do you have any plans to IPO? Are you looking into that? Is it something that you're thinking about in Italy? Would you list in Italy?
But I think Milan can be the town because I live in Italy, so it's also very important town for the luxury business. And we're working with my manager now for because to go to the IPO is not easy. You need really to be very perfect. And we're working with my manager in this direction. I hope soon, maybe next year, can be the right time to go.
And then, so what do you want to do afterwards? Would you acquire more brands to become bigger?
Well, we can acquire also now because, thanks God, financially, the position of our brands, of our company are okay, so we can go into the market also now. But we don't want to buy just for buying because many brands are available now. Also, they are available for a very good price. I just want brands that first can fit with the OTB group because we are very special, we are brave, we do special things. We really still working in a beautiful product and not just in celebrating, in a different way, like I told you before. And so we're looking for someone can be like with the characteristic that we are. And our creative director, they are a rock star. We don't have we don't have just a design office, a design team like the big brands. I think we have our creative director are really very, very super special.
Yeah, and I've seen you, Liz. I mean, I've seen you walk a shop where you care about the details, and you're in the details, and you're in the minutia. So how would you pick the next brand? Is it what you feel in the heart, or is it more about the numbers?
No, I love products. I come from the products because I was born in the product, and I'm working with my creative director. So this is why we are who we are. We are so special. And this is the way that I want to run in my business, my brand. And also we have one characteristic that are very special, that we are incredibly loyal because I believe in a circular economy. So we create, we produce, we deliver, we're making money, but also we give back to the community a part of what we have created. This is really part of the education that I received from my parents. Our foundation is really very deeply involved to solve problems, to helping people that have more problems than we have.
So interesting. Lorenzo, thank you so much. I hope this is one of many interviews here in the studio. Lorenzo, also they're the president and founder of OTB. Coming up, but we'll hear from the former Bank of England MPC member ahead of the monetary policy decision. This is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime. But we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising New York City?
The mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Now, the Bank of England is expected to keep interest rates on hold at 5.25%, with expectations of cuts mounting. Governor Andrew Bailey will have a tricky balancing act in his communications around the decision. Well, Bloomberg's UK correspondent Lizzie Burton outside the Bank of England for us today. And Lizzie, you're joined by a guest.
I am Francine, and the outlook economically is very different to previous Bank of England meetings, so I thought we'd check in with Michael Saunders, former Monetary Policy Committee member, on how his outlook has changed for the Bank of England. Thanks for being back, Michael. Do you think that the Bank of England today should follow the Fed in pushing back against market bets for rate cuts?
I think what they'll do in their own subtle way is to signal that interest rates are likely to come down during the course of this year, but perhaps not quite as quickly as markets price in. And the way they'll do that, most likely, is forecast that if interest rates follow the market path, which includes quite sizable easing for this year, then inflation will end up a little bit above the 2% target 2 years out and 3 years out. So that implies the market path for rates is a little bit too aggressive, too low. But they'll also forecast that if interest rates are stable, then inflation will end up below target 2 and 3 years out. So the implication of that is that somewhere between stable rates and the market path for rates is what the Bank of England thinks we should expect.
Well, if the Bank of England basically thinks that markets are getting ahead of themselves pricing rate cuts, but then the forecast is based on the market path for rate cuts, is the forecast even worth the paper it's written on?
So the forecast aims to communicate if the bank thinks the market path is plausible or not. It's not really designed to be a forecast of where inflation will go if the bank sets interest rates in line with its own views. Now, it may well be that over the next year or two, the Bank of England will change the way in which it operates, do something more like the dot plot that the Fed does, in which individual MPC members give their own forecast for interest rates, and then they base the forecast, the MPC's economic forecast, on that. So then I think you would have a collective view on the outlook for inflation and monetary policy, which would perhaps be more coherent than they have at the moment.
They can also communicate the future path rates through the guidance. Will it look tone deaf if they keep the hawkish bias in the guidance today?
Well, I think they will drop their previous references to it being a finely balanced decision of whether to hike rates or leave them on hold, and drop that little sentence at the end that suggests that they are still biased to hike. So their message will be on hold for now, but a forecast, as I said, based on stable interest rates, which implies that interest rates are likely to be coming down over the course of the year.
I'm interested when you would cut interest rates. Of course, we've got an election coming. If there's an early election this year, does that boost the case to cut sooner rather than later, so the bank doesn't look like it's helping Rishi Sunak's campaign?
So let's dismiss the idea that political factors would affect the path of monetary policy, except for perhaps one very narrow case. They might not want to make the first interest rate cut during an election campaign. I think their preference during an election campaign, the formal campaign of only 3 or 4 weeks, would be to just keep themselves in the background as much as possible.
So if that's in May, would you hold off hiking in May?
There might be a case for that. There might be a temptation just to leave it until the campaign is finished. But I have to say, I think June rather than May is probably the more likely time for the first cut anyway. The kind of sequence I would expect, leaving elections to one side, is to use the May monetary policy report forecast to signal the likelihood that interest rates are going to come down quite soon, give lots of speeches in the next few weeks, the few weeks after that, and then deliver the rate cut in June.
But if the bank doesn't cut soon, is there a risk that the bank's forgetting the lag in monetary transmission both on the way out of this inflation crisis as well as on the way in?
Yes, there is, and that's part of the difficulty of setting policy. The lags in monetary policy are longer than they used to be. That implies, if anything, the monetary policy should act earlier, more aggressively, in order to offset those longer lags. But the risk of doing so is that pay growth, services inflation are still relatively high, too high for comfort, and the risk of the MPC cutting early is they would send a message that they're happy with services inflation still being relatively high, and that might undermine their anti-inflation credibility. It's quite a tough balance between those two factors.
So if you were scoring the Bank of England's communications through this inflation crisis, where would you put them on a scale of 1 to 10?
Look, I think that all central banks will have learned from their experience through this. They've learned about how the economy functions and different ways of communicating. And you can see some advantages in the way that the MPC communicate. Equally, they would learn from the experience of other central banks. I think that's why this review by Bernanke is quite timely, quite useful. Let's take the chance to learn from the last few years, the last 10 years, 15 years, and see what works well elsewhere, and then perhaps adapt how the MPC communicates in the future on the benefit of that experience.
Well, of course, we also get forecasts today. If the bank does cut rates this year and that boosts growth, do you see inflation coming back in 2 or 3 years' time? Will that be an issue?
No, I think that the MPC have got on top of the existing inflation problem. Inflation is likely to be back at the 2% target quite soon, in the next few months, I think in April, and probably below 2% in the rest of the second quarter. Now, the challenge is then to make sure that inflation stays at target sustainably. And the thing to emphasize here is that policy is currently clearly restrictive, with interest rates well above neutral. If interest rates come down, let's say by 75 to 100 basis points this year, policy would still be fairly restrictive, helping to ensure that inflation stays low. And I think that kind of language of shifting from policy which is very restrictive to less restrictive, but still on the tight side, that's the language shift which the MPC are likely to make in the next few months.
Just finally, Michael, economists keep forecasting inflation incorrectly. That's making markets more volatile. It's making the Bank of England's job harder, making policy. For you, how bad is the data situation?
I don't think there are any worries about the accuracy of the inflation data. I think the issue in the last few years is that the UK economy, and it's the same for other advanced economies, has been hit by a series of extraordinary shocks, from the pandemic, the energy price surge, big swings in global goods prices and commodity prices, and that's created an inflation challenge really unlike anything that we had in the 20 years before the pandemic. Now, I think this sense of a world in which adverse supply shocks are more frequent, that may be something that we have to get used to. And that means that inflation may well be more volatile than it was in the couple of decades before the pandemic, and that creates extra challenges for central bankers. It's important to ensure that inflation expectations are well anchored, and that would be a reason for the MPC to just drag their feet a little bit over the pace of easing during the course of this year.
Okay, well, if the governor or the ex-Fed chair, Ben Bernanke, is listening with his review, there's some recommendations, a dot plot perhaps, when he reports in March. Back to you, Francine, and Michael Saunders. Thank you for joining me.
Thank you, Lizzie. Thank you. Lizzie Burden there speaking to Michael Saunders, a former Bank of England policymaker. Now, stay with us for the BOE decision when it happens. And, of course, for viewers in the UK, we'll have a special coverage of the news conference led by Guy Johnson. And then a little bit later, also our conversation with the Bank of England Governor, Andrew Bailey. That's at 4 p.m. London time. Coming up, EU leaders head into a high-stakes summit on much-needed financial aid for Ukraine. Don't miss our exclusive interview with the Ukrainian finance minister. That's coming up shortly, and this is Bloomberg.
Young adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg.
EU leaders kick off a high-stakes summit today on a €50 billion aid package for Ukraine. They'll have to persuade Hungary's Viktor Orban to drop his veto on the deal. Now, for more, let's head over to Bloomberg's Maria Tadeo in Brussels. Maria, it's going to be an interesting summit.
Yes, Francine, and you said this was a high-stakes summit, and it truly is. When you speak to European officials, they say this is the most important summit when it comes to Ukraine as compared to maybe 2 years when the sanctions were first introduced. They're very clear about this because of the repercussions. And to debrief precisely the ramifications of this, we're joined by Ukraine's finance minister, Sergei Marchenko, who joins us from Kyiv. Sir, today, of course, 50 billion for your country. You need that to pay for many things this year. What happens if you don't get the approval today?
Hello, Maria. Nice to meet you. Of course, all of us waiting for a decision, good news from Brussels. It's important for us that at least European Union is with us because we're also waiting good news from the United States. It's necessary. It's not something we can compensate by our own budget. So we really need these funds from European Union because it provides us midterm perspective as well.
And what happens if there isn't an agreement? The European Union says they could have a plan B, but do you have a plan B?
Of course, I would like not to think about plan B because plan B is to be in a different reality. We was in a plan B in 2022. I'm quite aware of what it means to be in a lack of resources when you should every day manage your liquidity gaps. That's why it can be very consequential for our economy, and I would like to do everything necessary to avoid plan B and to convince our partners to step in and to help Ukraine.
Exactly, and you avoided a default in many ways, which some was thought it was inevitable. But I wonder, having said that, the Ukrainian Prime Minister, Viktor Orban, he says he wants the capacity to review the spending on an annual basis and possibly veto this. Why do you think he's so concerned about this?
You know, our key concern is because of we really understand the necessity of such a support, and that's why we try to do all necessary efforts to communicate in a proper way to show why it's so important for Ukraine and why it's so consequential for Ukraine. And it's not just a matter of words. I want to emphasize this. In January, we received a very minor amount only from Japan, $0.4 billion, and we plan and use only our own money, which we raise by taxes and by domestic borrowings.
And sir, the Polish Prime Minister, Mr. Tusk, he said that if there's no deal, Orban will be responsible for throwing Ukraine in a very, quote, dark scenario. What does a dark scenario mean to you? Because what he's implying is that with no money, you could lose the war. That's basically what it is.
Of course, you know, I don't want to discuss possible consequences on a battlefield, because I'm not responsible for battlefield, but I want to discuss a possibility for our macroeconomic stability. And the consequences can be very damaging. We can meet a huge level of inflation. We can fully exhaust our reserve of National Bank of Ukraine, and it will be economic crisis as a consequence of not having support from our partners. Of course, we try to mitigate the effects somehow, but we can't survive without support.
And at the start of the interview, sir, correct me if I'm wrong, but I believe you said you're now expecting good news from the U.S. too. I know that the Treasury Secretary was in conversations with Kyiv recently. Do you believe the U.S., have they given you any indication that they will also pay up soon?
Yes, all of our communications which we had with our partners from the United States, they stressed that they are with us. They try to do their best to convince members of Congress and Senate to vote for Ukraine, to vote support for Ukraine. So we have no doubts that administration does every necessary steps to help us to get necessary support.
But did they give you a timeline? Did they say, we think maybe in the next 2 weeks is possible?
No, there is no clear vision on timing, so they're not committed on time, but they ask us to be aware that the money will come.
And sir, I have to ask you a question about the general sense of the Ukrainian government. As you know, there's many reports, and I know you're not aware of this file per se, but there's a lot of reports that President Zelensky may fire his top general. There's a lot of speculation out there. Perhaps there's tensions within the core of the Ukrainian government. The key has been unity, not just externally, but in your country too. How united are you with all of the pressures that you're facing?
You know, I prefer not to comment matters which are not of my responsibility. So please look at official comments from Office of President and President himself. I believe that we can find a good resolution of any possible conflict or crisis.
But the cabinet, in terms of you and your relationships, you're working as normal. You're working as you were working before.
Yeah, no problems. We all in a good relationship with Ministry of Defense, and we had a lot of meetings together, so everything's quite stable.
And sir, just as a final question, if there is a deal today, Ukraine was very specific that it needed the 50 billion euro green light in January, that it could not wait because it needed this visibility at the start of the year. So if there's a deal today, what's that going to do to your public finances? What's your budget situation looking like? And what do you see your shortfall being for 2024 if you get the 50 billion euros?
If you get 50 billion euros, it means that we at least partly finance until the end of the year. It means that we can guarantee support, and we can guarantee that we will have been able to provide necessary expenses for our citizens. And we will expect this money rather sooner than later in March we received signals that if today is a decision, the first tranches will be in March.
And just as a final question, the last time we spoke, you said to me that to you it was clear that Ukraine has to win this war. There's no other option. Has anything changed in your view, or do you still believe victory will come, maybe longer time, but there's no other option for your country?
There is no option, for our country except of to gain a victory, and it's a question of survival. It's a question of existence. It's not something we can debate, discuss, and make different trade-offs about. So it means that we should fight. It means that we should find necessary strengths within our country. It means that we should find necessary arguments for our partners to be with us. It means everything, because for us, it's not just the day-to-day business. We really believe that it's existence of our country depends on our current deeds.
Well, sir, thank you very much for your time, and of course on this very important day for Ukraine. That is the Ukrainian Finance Minister Sergei Marchenko joining us from Kyiv. And in the meantime, Francine, this summit continues. The question is whether or not there's a deal around Viktor Orban, who funnily enough today did not speak to the media, a low profile. That's very unusual from the Hungarian Prime Minister, who loves the camera and the attention.
It certainly is. Great interview. Our Maria today, they're of course following that special summit on Ukraine very, very closely. Now, coming up, we look ahead to the BOE rate decision, 12 p.m. London time. That's next, and this is Bloomberg.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
So Shell trading higher after the oil major beat expectations and kept up the pace of its share buybacks. Now, analysts were especially positive on the performance of its gas and upstream operations. Bloomberg spoke to Shell executive Wael Sawan.
It's a good, very good result for this quarter. We're pleased with the momentum that we are building after our Capital Markets Day announcement of June of last year on multiple measures, whether it's on the cash flow front, where we see continued and consistent delivery, on the improvement in our cost structures and in the capital discipline. All that momentum is building through, but we also recognize there's more to do, and there's still a lot more to deliver in 2024, but we have high confidence in the strategy and in the pace that we are building to deliver it.
That was the Shell Chief Executive, Wael Sawan. Now, we're also looking ahead, of course, to the Bank of England's rate decision later today. Joining us now is Bloomberg's Ven Ram from the MLive team. Ven is the person I go to almost BOE decision, every BOE decision, try and figure out what happens to gilt. So, Ven, I mean, it's going to be difficult, actually, for the governor and the MPC to guide the markets without giving them any forward guidance.
Morning, Francine. Absolutely. The markets are kind of riding their own hobby horse. They're thinking that there is a 70% chance of a rate cut in May. I don't think that's possible. I mean, one of two things has to happen for the Bank of England to deliver a rate cut in May. The economy has to fall off a cliff. Is that happening? Yes, the economy is weak, but it's not falling off a cliff. We got the January PMI numbers, which showed a reading of almost 54. That doesn't suggest an economy keeling over imminently. And if you look at the inflation picture, you've got headline inflation running at 4%, and you've got services inflation running at 6+%. So I don't know what it is that the markets are smoking. The Bank of England is in no position whatsoever to say they will cut rates in May.
And so, Ven, so is there a bias actually in the markets that is pushing, you know, what happens to gilts on the back of this if they really push back, especially what we heard from the Fed yesterday?
Yes, I think that, you know, Andrew Bailey and will push back on that notion during the press conference. And the statement, indeed, I expected to reiterate that rates need to stay restrictive for longer, even though the best case for the Bank of England is that they may not have to raise rates from here. And I think the language might acknowledge that. But that is as much as a concession that they will get. I think the BOE has reiterated that message. Andrew Bailey said that in testimony to Parliament, that unless services inflation comes down a whole lot, we are not going to see headline inflation crumble. Catherine Mann has made that same point as well. But it's, as you mentioned, it's a point lost on the markets, but they will realize in good time.
Thank you so much. As always, Ven Ram, they're looking at some of the BOE conundrum and decision. Up next, it's a Bloomberg Brief with Manus Cranny in New York, and this is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, you know, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
DOJ or other authorities
Could face bigger challenges next.
Was going to keep rain World Cup.
This is a 3
as the economic picture does.
The OK is getting ready to make a decision.
The tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Good morning from our world headquarters in New York. I'm Menace Cranny. You're welcome to Bloomberg Brief. Let's say your agenda. The risk-off mood pervades across markets. The Fed Chair Jerome Powell pushes back against a rate cut next month.
I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that. But that's to be seen.
The Bank of England's up next with expectations of a cooler inflation forecast, potentially opening the way for easing. And banks bonanza. Deutsche Bank plans to cut jobs. BNP Paribas lowers the targets. And Julius Baer's CEO is to step down. Very good morning. Welcome to the show. It is all about inflation. We focus in on the European inflation story, and this is what we have in terms of breaking news. For the core year-on-year, January 3.3%. So year-on-year ticks up ever so slightly. The CPI month-on-month down 0.4%. You saw a 2-year low for French CPI yesterday. Some of the regions in Germany, of course, were ticking a little bit higher yesterday. So the overall level year-on-year for the core comes in at 3.3. Again, this may just cause a little bit of hesitancy in the euphoria about when we may get rate cuts. That is the euro-dollar. The euro's down by 0.2%. So inflation slows less than expected, clouding the horizon, as I say, for the ECB. So 2.8% from a year ago in January. The estimate was for 2.7%. That's on the CPI. We'll keep an eye on those, of course. Next up, it's going to be what happens with the Bank of England and Bailey in terms of the inflation forecast there. Now, when it comes to puncturing the enthusiasm of equity traders, Jay Powell still has swag. He took yields down and stocks down yesterday, very clearly taking the euphoria out of the market. That carries through on the equity markets this morning. Let's have a look at those. This is what we've got for you. We're just turning slightly into the green, up a quarter of 1%. We gave back 1.5% yesterday on the American indices. It was one of the worst days since late autumn. He's dashed the hopes of a March rate cut. They want continuing evidence. What is that continuing evidence? Tonight we're going to get Apple, Amazon, and Meta, or sorry, later on this afternoon. That is 15% of the S&P 500 will report later today. Flick your attention across to the Stock 600. I mean, we've got a feast of banks. We'll get to Oliver Crook on those. And keep an eye on Paribas because we have got, again, cutting targets there. The net income 50% lower than was estimated, and that is on legal charges. But I want to draw your attention. There's Paribas down nearly 9%. Adidas is particularly important. They took $1 billion of a hit €1 billion of a hit, I should say, on their FX exposure to Latin America, and they still have inventory of Yeezy. So Adidas down 5.3%. In terms of the rest of the assets, this is what we've got for you. I mean, look, Powell, the title that we've got is that he cemented the pivot, but he delayed the turn. Yields this morning at 394. He certainly didn't do what Bob Michael suggested at JP Morgan Asset Management, which was drop the mic and just get on with it. They really are frightened of their own shadow at the FOMC at the moment. The dollar ticks higher. We've got a risk-off mood generally in the past 24 hours. The dollar's had a fairly strong run, and oil up 0.8%. Despite U.S. output reaching fresh record highs of 13.3 million, we're waiting to see what the response is from the US to the Jordanian attack. So I mentioned it was a feast of banks, and Deutsche Bank seeks to make good on the pledge to lift the profitability and return more money to shareholders. The CFO sat down with Oliver Crook about how the first month of 2024 is shaping up.
Fixed income and currencies for us at 1% up on last year, which was a strong, fourth quarter, was actually encouraging. And to your question, momentum is carried through into 2024. So we've had a strong January, and we also, if you like, think the environment now, finally, after 2 years of going backwards, should be much more conducive to corporate finance activity, financings, equity deals, M&A deals, just because all of the sort of the setup conditions
you see that coming back now?
We do. Yeah.
It's not too early?
No, look, it's been delayed. We sort of thought it would be a second half of last year event. Of course, interest rates and perhaps some uncertainty on the geopolitical side, held activity back. But now with rates declining, I think a better view of the economy and where we're going, the need to refinance against just maturities that are coming, and also animal spirits on the strategic side, we think that is coming back in 24.
And so, sick man, tired man, sore athlete, Germany, what is the sort of catalyst? We know that there's underlying strength in the German economy. What is less clear is what brings it out of the funk.
Well, I think a few things. I think there's a policy mix that would really help the economy around sort of bureaucracy, regulation, around employment, making sure there's qualified staff to fill the jobs that are available here. Financial conditions, including capital markets union, banking union. So there's so much that we can do to help ourselves and really unlock this economy.
That was the CFO of Deutsche Bank with Bloomberg's Oliver Crook, and it was a big day for the European banks. There was the good, the bad, and quite frankly, the ugly, which is Paribas in many shapes and forms, down nearly 9%. Crook joins us now. You've just got out from the Deutsche Bank interview, well pushed with von Moltke. But this is about a commitment to shareholders and the truth and reality that there are going to be more job losses within the organization.
Absolutely, and it's also a question about going kind of slow and steady. So they returned $1.5 billion to shareholders in the form of the dividend, up by 50%, also a share buyback. And there's still several billion sitting on the sidelines. I pushed them on that. When is that going to go back to shareholders? And it seems like they are planning to give more in the back end of the year, and they want to give more than they had originally intended, $8 billion to shareholders over 5 years. So all of that is looking good. You can see it in the share price today. That is part of the optimism. The other part of the optimism is FIC. Fixed income trading. They were up 1% in the quarter. It was a little bit under estimates, but that beats the peers in the U.S. down 10%. BNP absolutely being crushed in fixed income trading. So really, I was really struck by his optimism. Despite all the sort of headwinds, they really see deals coming back. They see M&A coming back. So really optimism from James von Moltke at Deutsche Bank.
I mean, that's a heck of a call, isn't it? I was drawn to that line as well. The environment now, finally, after 2 years of going backwards, perhaps that bottom is in. I can't get a cup of coffee with any of these New York buddies of mine that are bankers, Oliver. I don't know what you've done to them all. They're all out writing tickets and deals.
See what we can do.
See what you can do. The fact that you've turned up in a shirt and tie for this show, that's a red headline. Talk to me about Paribas, because it's a very different story. There's legal charges. It's a mess. I mean, net income down 50%. And they don't have any sort of glory trades to show us, do they? Well, not many.
No, you have almost the opposite story there, Manus, where you had a sort of miss on the kind of revenue outlook. They're putting that downwards. You had a massive miss on FIC. I mean, FIC is huge for BNP Paribas, the fixed income trading, down 32%. That's even worse than what we saw out of the United States. So no good news there. And again, when you try to look at the outlook and try to get maybe some optimism there, it's really not there. I mean, the CFO, we did an interview with him on Bloomberg TV earlier today. He says he is seeing trading activity coming back in January. We saw that from James von Moltke as well. However, definitely not enough for investors. You can see down almost 9% this morning.
Now, Julius Baer, I mean, Swiss banking and calamities, they literally are coming along like buses, aren't they? This time it is Philip Rickenbacker. He is to step down, and this all coagulates around exposure to an Austrian property developer. This man was brought in to turn the bank around, and he did that. So it's a hasty departure, unexpected departure. How would you categorize it? How would you characterize it?
Yeah, I mean, this is a sort of masterclass in exposure, excessive exposure to one place. I mean, they're writing down all of their loans to Cigna. This, as when the story came out in November, they're talking about something like 600 million euros worth of exposure to Cigna. That was about 40% of their private loan book, 40%, Manus. So, of course, colossal exposure. Net income, now we saw it in the earnings, down 52%. CEO is gone. You're going to have compensation cuts across the business. You know, and they're abandoning their private loan business, right? So the question is, does this draw a line under it? You see the shares are up a little bit. Maybe they did have inflows in November, December. But Manus, as you say, let's take a step back. Swiss banking 2023 began with the collapse of Credit Suisse. Now, Julius Baer having to deal with this crisis, stepping away from the private loan book. That leaves Zurich a pretty lonely place, Manus, with one person standing very tall, friend of the show, friend of Manus Cranny, Sergio Armati, who's got earnings out next Tuesday.
Absolutely. What's he going to do? He's sort of suspiciously quiet at the moment. I mean, that integration and regulation of Swiss banks is at the heart of the angst, and very well put. I mean, the chairman has made some comments, Oliver's, in terms of misjudged the risk linked to Cigna exposure. But I know what it's like in the frenzy of writing tickets, doing deals, you're bringing home the bacon, management are happy. And when management are really happy...
Absolutely, and when the dust clears, Manus, you know, this is more flow to UBS.
There you go. More money for Sergio. Oliver, great work with Von Moltke, and as you say, a hell of a year for Swiss banking. Oliver, we'll see you through the morning. Oliver Crook in our Frankfurt studio. Other stories that are trending on your Bloomberg terminal this Thursday morning. I mentioned it at the top. Adidas, the shares slump. The German company says currency swings will worsen the effects of a slowdown in the sports apparel market, restricting its earnings to less than half the analyst estimates. Adidas plans to mitigate some of the damage by selling the remaining Yeezy inventory at cost. Roche shares are also falling. The drug maker forecasts a sluggish recovery in sales and earnings this year as they emerge from the difficulties of 2023 and a string of research setbacks. The stock fell the most in more than 3 months today. It has underperformed its peers over the past year. Qualcomm shares swung in late trade before finishing flat. That's after the company said it expects only a modest recovery in 2024. The world's biggest maker of smartphone chips says the sales of mobile devices may go up slightly this year. That's after a decline across the previous 12 months. Now, Qualcomm's profit and revenue for the quarter ending in December were both above analysts' estimates. And a headache for emerging for lenders with the U.S. commercial real estate turmoil. NY Community Bank Corp plunged yesterday. That was after slashing the dividend and stockpiling reserves. That has prompted Moody's to warn it may cut it to junk. Now, in Japan, you've got Aozora Bank sliding 20%. They forecast a loss on U.S. commercial property. That is in the space of 24 hours. The alarm bells are ringing now violently on bank balance sheets in regards to commercial property. Coming up in the show, 11 minutes past 5 in New York. The timing of a rate cut. We'll discuss that with Vanguard's Jumana Salihan. She joins me next. Now, later this hour, we'll speak to the former BOE MPC member, Martin Wheel, right here on Bloomberg.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Our policy rate is likely at its peak for this tightening cycle. If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. We're looking for greater confidence that inflation is moving sustainably down to 2%. I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting. We're planning to begin in-depth discussions of balance sheet issues at our next meeting. We're not declaring victory at all at this point. We think we have a ways to go.
The Fed Chair Jerome Powell setting the expectations for the timing of a rate cut and pushing them back. Jumana Salehin joins me now, Chief European Economist over at Vanguard. I mean, what more do they want? They want greater confidence. So I had various people yesterday. Bob Magagoni should have just dropped the mic and said, job done. And I've got Neil Dunn saying, oh, brother, what exactly does greater confidence mean? What do you think constitutes greater confidence?
I mean, at the end of the day, as Chair Powell said yesterday, they are in risk management mode, right? They don't want to cut too early and see inflation reignite itself, what they saw in 1967. They cut rates, they thought they were out of the woods, they declared victory, and hey, guess what happened? Inflation went up again, and they had to hike up, a few percentage points. They really want to avoid that, so they want to make sure they're seeing this further improvement in inflation, good data, as Chair Powell called it, to have that confidence.
But what do you think that is? Another 3-4 readings of PCE coming in. I mean, the 3-month and the 6-month PCE are now at the money, if not a nib better. So do you think it's that portion, or do they want to begin to see? I mean, unemployment will come in tomorrow. I think it's a string of sort of 4 and sub 4% unemployment. What is it that they're going to need to see, Jumana?
It is a combination of growth and inflation, right? The activity side and the price side. So since the last Fed meeting, they've had very bullish news on the growth side of the economy. The economy is still roaring, labor market's still hot. It is cooling, but it's still above the level that is consistent with trend growth. And, that's above trend. That's sort of signaling boom. And really what we should be seeing is a slowing of the economy. So they're going to be looking for information on both sides of the coin.
As far as bullish optimism, loose financial conditions, one could say that Powell did a pretty excellent job yesterday. Some of the tech earnings weren't just as effusive as the market had anticipated. He has managed to quash and slay March, and to a certain extent taken some of the heat out of financial markets. Not a massive amount, I grant you. Stocks are only down 1.5% on the back of it, and yields dropped ever so slightly. But is that something that we should look at as a welcome?
Yes, I think so. I mean, you know, at the moment, markets, yes, you're right, they pushed it back, not from March, now it's in June. But really, they're still expecting 150 basis points of cuts in 2024. So that's beyond March. Every meeting, they're expecting 25 basis of rate cuts. And, you know, there is still big risk. We don't really know why the economy is growing so strong in the US at the moment, why the growth numbers are so strong. There are clearly been improvements on the supply side of the economy. And maybe then, you know, if supply is stronger, demand can go stronger as well. So if in that episode we start cutting, you could actually see the economy overheating. So yeah, you know, I don't think markets have, at the moment, they're still pricing in quite a lot of cuts into the year, which it would be consistent really with a more of a recessionary outlook. The number of cuts that are priced in is when the labor market is weakening and unemployment is rising. Otherwise, as you know, the last dot plot showed, there were only 3 cuts priced in to what the Fed were thinking, right? So there's a big gap between 3 and 5 to 6 cuts.
There is, and that can have an impact on risk, even though everybody tells me, no, we're not worried about, we don't need 5 or 6 rate cuts to hold these record highs in equity markets. No, they've obviously not been through a few cycles. Right, let's pivot to the Bank of England, because I've got various notes saying to me it's going to be a unanimous decision. I've got people saying to me there's going to be a vote for a hike from one of the members. Tell me how you think it's shaping up. I mean, they are going to be the last of the party of cuts, aren't they?
Yeah, no, absolutely. I think, you know, there's definitely going to be a majority for no change, you know, whether that's unanimous at 9 or 7 or 8. You know, that we have seen quite a lot of split votes. And really, why are we seeing those split votes? The UK is in a different position. You know, inflation is still high. Core inflation is still high. On Vanguard's forecast, we don't see core inflation going back to 2% until next year. Although headline, because of positive news on energy prices, we do see that returning this year. So on the whole, I would say, you know, the forecast will be much more positive. On the constant rate forecast, inflation's going to look weaker and growth is going to look more positive in what we see later on today.
It's interesting because, of course, they've got inflation at 4%. That's the highest of the G7. And then you get big notes coming out from Goldman's and PGIM saying, actually, sterling's going to rally because they're going to be the last to that cutting party. Jumana, thank you very much. Jumana Salaheen with me this morning on markets. And it is a big day for bond markets in the UK. There you go. You've got UK bond yields just ticking ever so slightly higher. As I say, the nominal inflation is the highest in the G7. What will Bailey intimate? Bond yields in the United States, 394. We're on our way to a jobs report, and that is expected to see unemployment drop for the 26th month in a row below 4% on Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
It's Bloomberg Brief. I'm Manus Cranny in New York. More earnings are coming this morning. Shell reporting strong results from its gas traders, keeping up the pace of its share buybacks. The CEO says he's optimistic for the coming year with robust demand for natural gas. Bloomberg's Tom McKenzie spoke to the CEO, while Swan.
What's, I think, key in 2024 is there isn't a lot of new supply coming into the market. And so as you go back into stock refilling after the winter, I suspect you'll see robust demand. So for the coming year and a half, I think there'll be some good demand. I think one thing to keep in mind in the medium term is China, again, will draw a lot of gas. To give you a sense of that, just in 2024 and 2025, the volume of natural gas power generation capacity that China is building is equivalent to the entire installed capacity in the UK today. And that's just China's build-out. So there will be a lot of demand for energy.
That was the Shell CEO, while Sawan speaking to Bloomberg a little bit earlier. Great context around the demand for gas. And just on that note, the U.S. House plans to vote on overturning President Biden's freeze on natural gas export licenses. And that was a story that we broke just a few days ago. And this is in response to the administration's action. That vote will probably take place next week, we understand. The Representative Kathy McMorris Rogers, she chairs the House Energy and Commerce Committee. So this is the House going head-to-head with Biden as U.S. production of oil and gas. It's 13.3 million barrels of oil, so a record there. Let's see. This is shaping up to be a battle royal between the White House and Congress. This is state of play on the commodity markets this morning. We're up 0.9%. We are rising. We do not know what the U.S. response will be to the Jordanian attack. Of course, the market was down 2.5% yesterday, clawing some of that back. Brent up 0.8%, and natural gas flying high, up 2.38%.
Been so used to the fact that every time there's a problem,
central banks come and ease. This has been the kind of playbook, you know, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted, and I think many people, even in the markets, have not quite understood, in my mind, how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Welcome back to Bloomberg Brief. I'm Manish Krenny in New York. Here's what you need to know. It's a risk-off mood for the markets. The Fed Chair Jerome Powell pushes back against a March rate cut. Next up, the BOE decides, with expectations of a cooler inflation forecast, potentially opening the way for an easing. And it is banks bonanza. Deutsche plans to cut jobs. Paribas lowers its targets. And Julius Baer, CEO, is to step down. Plus, we're getting ready for Apple, Amazon, and Meta. The 3 companies will wrap up a blockbuster week for tech earnings. That is after the closing bell. We gave back 1.5% yesterday. The slayer of optimism, Jay Powell, came and he cut a swathe through a March rate cut. We want more evidence. What more evidence do you want? What some would say, you know, it's almost as if they're frightened of their own shadow. Anyway, stocks managed to have a small reprieve, up 1/3 of 1%. What is the continuing evidence that the Fed actually wants to see? 15% of the S&P 500 will report this evening after the bell. We'll talk more about that at the end. You've got Apple, Amazon, and Meta to come. NASDAQ futures up 0.6 of 1%. But it really is Europe where you have quite a tragedy. You have 2 very different stories between the banks. You have BNP Paribas missing their net income by 50% due to legal charges. You also have on the other side of that story as well, you have provisions rising. That is something you really want to keep an eye on. Provisions at Paribas rise nearly 40%. Stock is down 8.3%. There's a big theme this morning in markets. Yesterday, it was New York Community Bank Corp. Deposits, they bought the deposits from Signature, cutting the dividend. Today, it's about the 16th biggest bank in Japan. Property losses here in the US. Keep an eye on Adidas as well in Europe. It's a tragedy for Adidas. They've taken €1 billion of a hit when it comes to their FX positions. Cross assets, we're trying to sort of mull over what this means from the Fed. The messaging yields 394, a dollar ticks higher at 12.33, where we were in a risk-off mood and the dollar went bid. Crude is up 0.7 of 1%. We did drop by 2.5% yesterday. Again, we wait to see what the U.S. response is to the Jordanian attacks, and the U.S. is producing 13.3 million barrels. That is the weight of supply. So a little bit of breaking news for you now. The European Union leaders have reached a deal to send Ukraine 50 billion in aid. So this is the latest breaking news headline from the EU leaders. Aid is on the way to Ukraine. Let's get to the Bank of England. It's got a decision at 7 a.m. Eastern time, and they are expected to hold the rate steady. Bloomberg's Lizzie Burden is on the ground at the BOE with a very special guest. Lizzie, good morning.
Thanks, Manus. I'm joined by Martin Wheel. He's a former Bank of England rate setter. He's now an economics professor at King's College London. Martin, thanks for being back with me on this chilly February morning. If you were at the Bank of England, when would you start cutting rates?
Well, I certainly wouldn't start cutting rates today. I think we have to wait to see how the economy evolves. On the one hand, inflation may well be quite low by later in the spring. On the other hand, of course, measures of underlying inflation have been holding up, and the MPC will have to manage both of those pressures.
So should the governor at least signal that the cuts are coming? Markets expect the first cut will come in May.
I don't think the governor should signal that cuts are coming. He doesn't know what's going to happen between now and May, what's going to happen to the inflation rate. All sorts of things could go wrong, particularly given the international political situation. So I think it would not be a good idea to indicate that a rate cut was going to come in May.
Well, you mentioned the international situation. Won't you look a bit out of step, a bit tone deaf, given the signals from the ECB and the Fed?
Well, the ECB and the Fed may think that they know the future, but I'm not convinced they do. I think that there's a lot to be said for the argument Mervyn King used to make, that the decision has to be made on its merits at each MPC meeting.
OK, so choose to be the silent boyfriend rather than the unreliable boyfriend, perhaps. Your successor on the Monetary Policy Committee, Michael Saunders, was with me earlier. He reckons that even if the Bank of England cuts by 100 basis points this year, effectively, it'd still be tightening. Where's the neutral rate for you?
Well, I don't think at the moment it's possible to say where the neutral rate is. We're finding our way there. No, interest rates, I think, probably will be higher than they were before the epidemic. But quite where that's going to settle, I don't think anyone can be sure.
I also find it hard to believe that the Monetary Policy Committee can completely tune out the politics. Of course, we've got an election coming in the UK probably this year. Is there a case to cut rates sooner rather than later so that the bank avoids the accusation that it's helping Rishi Sunak's campaign?
Well, I think if it does see a cut appropriate, whenever it makes the cut, people will be saying that it's helping the Conservatives, win the election, or the opposition will be saying that. So I don't think that problem can be avoided. I think the safest thing is to stick to the position that the judgment is made on the basis of the economy and taking government policy as a given.
And is there a risk, if they don't cut soon, that the bank forgets the lag in monetary transmission, both on the way out of the inflation crisis as well as on the way in?
Well, I think the problem with the lag is that it's very uncertain. Of course, if the lags are longer than many people on the committee have been assuming, then there may be further effective tightening coming from the changes that were made in raising the bank rate to where it is now. But you can't time these things precisely. Different members of the committee will have different views on timing.
So if the governor doesn't give us guidance on the future path for rates, as you suggest he should, a lot in markets will be looking to the vote split. Do you think that that's a reasonable indication or a useful indication of the future path for rates?
Well, I think it's certainly a safer thing to look at than hoping the governor will say something. I mean, he obviously isn't in a position to give much in the way of guidance because there are 9 people on the committee who make the decision, not just one. And the committee votes on current interest rates, it doesn't vote on future interest rates.
And there's never been as much divergence in views on the Monetary Policy Committee as over the past 12 meetings. There hasn't been a unanimous decision since September 2021. Is that healthy?
Well, I think it's reassuring to people. No, it informs them that there is a lively discussion on the committee, and it's in the nature of things that different people hold different views. But I remember when I was on the committee, we had at least one member arguing for a tightening of policy at a time when another member was arguing for an easing of policy. So these splits do happen. People are, of course, worried about the idea of groupthink. These splits are reassurance that groupthink isn't happening.
OK. We'll also be watching the forecast closely. How much of an issue is it that the forecast is based on the market path for rates when the Bank of England's language suggests it doesn't endorse that path?
Well, the forecast may well support that. If it shows inflation being above target at the 2 to 3 year horizon, the implication will be that interest rates will be tighter than the market path. So the forecast can inform on that. It's not, hiding this difference.
And you also have an important role as chair of an official committee that looks to strengthen official economic statistics. There have been a lot of complaints about the data recently. How worried are you about the way that's impacting market volatility, but also policy making?
Well, in terms of my committee, it looks at different things from the way in which the data are currently produced. We address issues like, technical issues like how non-monetary gold ought to be handled in the national account. Not everyone's major concern, but it's a rather niche topic, exactly as you say. On the issue of the data, I mean, as far as I remember, the revisions that we've had to data in Britain haven't been terribly different from those that other countries have had. I think the ONS, if they talked about updates as more information becomes available instead of revisions, then that would help explain to people the reality of the process, which is that some information takes quite a while to come in. For example, information on tax payments, though companies and individuals produce tax returns quite a long time after they've received the income, so you should expect to learn from those, and they may tell you something different from what you'd thought already.
Okay, Martin Wheel, Professor of Economics at King's College London and former Bank of England Rate Centre. Great to have you with me again. We'll wait for that decision at 12 p.m. London time, 7 Eastern time. Manus, back to you.
Izzy, thank you very much. Great conversation there with the context around what's set to come. Of course, it was a pretty big split in December, 6-3 in December time, with 3 voting for hikes. Okay, let's keep you up to date, because that Bank of England decision later on will bring you our conversation with the Bank of England Governor, Andrew Bailey, 11 a.m. Eastern time, 4 p.m. in London. Coming up, we're going to talk Boeing. CEO Dave Calhoun makes his case for redemption. We speak to Jefferies analysts right now.
Studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
Sports and money, they've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Bloomberg UK, your your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
We caused the problem, and we understand that. We instituted additional quality controls and inspections at Boeing and at our supplier. We issued bulletins to suppliers to strengthen the focus on conformance and reducing the risks of quality escapes.
The Boeing CEO, Dave Calhoun, taking responsibility for the company's earnings call yesterday for the problems around quality control. Joining me now is Sheila Kahyaoglu, aerospace, defense, and airlines analyst over at Jefferies. She has a buy rating on the stock and a target of 315. Sheila, good to see you this morning.
Thank you.
Thanks for getting up early. Look, what goes through my mind, it was very much a mea culpa call, but the skeptic in me, having seen many a crisis in my time, was this just a PR cover, no guidance, or is this a real deep-rooted concern, Sheila, that they are going to take a hell of a knock on the order book?
I don't think they're going to take a knock on the order book. Providing guidance, no guidance, was a clearing event in a way. There's no bogey for them. They didn't provide guidance for the FAA to say, you know, we'll step back, we'll do what you please, because you're going to audit our lines now, and we can't go up in production. They also pulled the MAX 7 certification exemption, so they were looking for an exemption. So the MAX has 4 variants, the 7, the 8, the 9, and the 10. 7 and the 10 haven't been certified yet. We thought they were going to enter service at the end of this year. They pulled the 7 exemption the day before earnings.
So what does that mean in terms of the timeline, let's say, for the production uplift on the new product?
So that's a great question. So production uplift is going to get us to a 315 target price of 50 per month. They're currently at 38 a month. The FAA is going to keep them at 38 a month until they say, A-okay, this manufacturing process is okay. To get to 50 a month, they need the FAA approval, but they also need the MAX 10 to come in. The MAX 10 is very significant in that it's 25% of the order book, and it's big for some key airlines like United, Delta, Alaska. So you want to keep that there. You don't want to lose them to Airbus. So they really need that certified.
But if we're delayed, if the certification is withdrawn and there is a delay, and you say MAX 10 is the real fulcrum of the future valuation, how much of a delay do you think we're looking at?
So 2 things drove the stock up. One is that they're at 38 a month on production.
Yep.
Folks thought the cap could be below 30. At 38 a month, that gives them about $5 billion of free cash flow just from the MAX in itself, and they generated $4.4 in 2023. So that gave them a buffer. The second thing that made the stock go up was they said the MAX 710, although they don't have an exemption from the FAA, they could redesign the part and have it redesigned in the next 9 months. So it wouldn't actually push out the entry into service very long, probably into 25, not into 26 like people were expecting. So those 2 reasons drove the stock up yesterday.
Okay, I mean, and by the way, when you look behind, you know, sort of pre-Alaska, and you look at the core of the numbers, you could say Calhoun has done actually a reasonably good job. Commercial first profit since the start of 2019, best revenue, $22 billion, and a free cash flow of $295. Without the hangovers, without this sort of quite significant hangover and interruption, how would you describe Boeing relative to its peers?
I mean, it was a low bar in terms of the revenues. We've seen aerospace really enjoy the momentum. We're just seeing air traffic get back to 2019 levels. So we're really enjoying the benefits of that. And it's about which suppliers or OEMs could materialize the best pricing. And that's really what will drive Boeing over a $300 stock, is if they could get pricing. But in order to get pricing, they need to eliminate quality events like this.
Do you trust them? I mean, you know, we can talk about it in lots of different ways. Has Boeing got a structural internal control problem that they're just not facing? Or have they got a supply chain problem that they just don't have a grip of?
I think a little bit of both. I think what strikes folks is that the MAX post the grounding must be the most scrutinized manufacturing line on the planet. I think we could all agree on that. So how do issues like this happen?
What worries
and what
me
else
is why wasn't it scrutinized before the door fell off?
I don't know what else management could do. And, you know, Dave Calhoun talked about vertical integration maybe going too far, that they've outsourced perhaps too much to folks like Spirit.
Right.
So we'll see how that changes. But, you know, at the end of the day, the MAX is 1 million parts, and to keep an eye on those parts is quite the task.
It is, but that's what the regulator is supposed to be there to do, and quality control within the organization. I mean, it's just, I don't expect a response on that, but that's just a sort of a human nature, which is, I don't care how many parts you got. You're there to put airplanes in the sky. Get it right. China's back on the book. Now, you say this is going to be a catalyst to burn off inventory. What does that mean? So this is China Airlines upping their deliveries of the 737 MAX. And that's after 5 years of a halt. So translate that into numbers.
So it was very interesting. That was probably the third thing that got the stock to rise. Every 15 minutes, a plane would take off to China. We've only had one delivery to China in the last 5 years, essentially, from Boeing. And then during the conference call, every 15 minutes, a plane would take off. It was an interesting event. And why is China so important? China's 15% of global air traffic. Boeing has not delivered aircraft to China in the last 5 years, essentially. So if that comes back, that's not currently in their production guidance or their guidance for the $10 billion of free cash flow that they have out there for 25-26 timeframe.
So a big boost.
Yeah, it would be.
Sheila, thank you very much. Great context with us this morning. My guest on Boeing, Sheila Kayalu from Jefferies with her buy rating on Boeing. Snapshot of risk for you. You know, we had a risk-off day in equities yesterday. The dollar went bid. It gives a little bit back this morning. It's flat. 12.39.11 is where we are. Euro dollar is down. We had some inflation data here in Europe this morning. We're down 0.2%, but that's more on dollar substance. We're waiting for the Bank of England. What will they say? We expect rates to remain on hold. How split will the committee be? Sterling down 0.4%. You've got big bullish calls out there to 130 from the likes of Goldman's, because the Bank of England will be late to the dancing party of rate cuts. So it is tech earnings abound later today. Apple, Amazon, and Meta will all report. That is next. What can you expect? Right here on Bloomberg.
Let's go inside the boardroom. Let's suppose you win a proxy fight or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside of that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
Bloomberg Brief. A very good morning. I'm Manus Cranny in New York. Let's look ahead to the rest of the day. All eyes down for the Bank of England. It is their rate decision at 7 a.m. Where will they go with the guidance? That's probably the more important aspect of the day. Then we turn to the US. Another round of initial jobless claims at 8:30 a.m., followed by the PMI at 9:45 and the ISM manufacturing at 10 a.m. And of course it is big tech, big earnings, Amazon, Meta, Apple, all after the market closed. Joining me now to run through what you can expect, it is Aggie Cantrill. Aggie, this is an important one for Apple. They got to break the decline in sales, will they? Good morning.
Good morning, Manus. Yes, 4 straight quarters of decline is what Apple's already seen. They're trying to make sure that it doesn't become a 5th straight quarter. And that's really looking at the sales, especially for their core products, their smartphones. Of course, they also this Friday will be announcing, they will be launching the Vision Pro on the market. But really the concern for Apple is essentially what's going to happen to their smartphone sales. Are they able to buck this trend of a smartphone sales slump, especially when it comes to China? What are those sales going to look like in the domestic Chinese market?
And where should we pay the closest attention to in Amazon?
So it's a twofold thing with Amazon. Firstly, looking at China, there are these competitors within the e-commerce space that are eating a bit of Amazon's market share, a lot of which are these e-commerce companies coming from China. That's a concern for the e-commerce giant. But as well, the other thing that's interesting for Amazon is also their cloud business and how well their cloud business can develop AI capabilities in the same way as we've seen Microsoft invest for their cloud provisions with their commitments to OpenAI, and also what we're seeing Google Cloud do. And investors will really want to hear what AWS is going to be doing to developing their own AI capabilities for the cloud.
I thought it was staggering. It was one of those moments yesterday when Mark Zuckerberg was really pushed in front of the congressmen to make an apology. He stood up, turned around, and he apologized to the audience when he was pushed by Josh Hawley, really. There you go. This is the moment. I mean, this is quite staggering. Unprompted. He was being grilled in the Congress for hours. I'm sorry for everything that you will have gone through, Zuckerberg said yesterday. And this was about, you know, the advocates that you can see there are parents holding up photos of their children. So it really was, he was put on the spot. But he's going to be put on the spot by the markets today. What has he got to deliver?
Yes, so that was a really quite telling moment for the social media giant, because essentially it's something that Meta has been trying to tackle for a long time. But also this is hitting a broader concern of exactly not just how they moderate their platforms, but also about the ways in which they're developing tech in order to continue developing these platforms and engaging with potential new threats. And a big one there is also, of course, AI. There is another aspect of AI that investors will be interested in when it comes to Meta, and that is essentially how they're using AI to make to permit precision advertising, to essentially make the adverts that people see more precise, because that's really the immediate value add of artificial intelligence on Meta's platforms.
Okay, Aggie, thank you so much. That is very well rounded out. I should just qualify what Zuckerberg was apologizing for. Those were the victims of sexual exploitation across the media platforms. It was a pretty brutal grilling. Let me just show you. We have one big mover. It collapsed yesterday in early trade in New York. This is New York Community Bank Corp. It's higher pre-market by a slither. And this stock was brutal yesterday, down over 30% at one juncture. They bought the deposits from Signature Bank. They cut their dividend. They've got a loan loss provision of $552 million. And of course, there's a risk of a downgrade coming through. That is the real risk now for the bank. Commercial real estate is in focus. That's Bloomberg Brief. Surveillance is up next. That'll take you through the next 3 hours on Bloomberg.
venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
What do we want to see? We want to see more good data. I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting.
I think that's the story. Is it May? Is it June? It's not March. It's pushing back because they don't want to rush into a cutting cycle.
If the economy wasn't as strong as it was, the Fed would be much more inclined to cut rates.
Markets really want to take off and put a lot more cuts in than the Fed is really willing to do.
Jay Powell thinks the runway for a soft landing's in sight, but right now that's a forecast.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
It's like we never left. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowitz together with Anne-Marie Hordern. I'm Jonathan Farrow. Your equity market on the S&P 500 bouncing back from the biggest one-day loss since September. Equity futures on the S&P 500 positive here by 1/3%. Bramo, pushback from Chairman Powell. Big earnings coming a little bit later.
Yeah, basically taking March off the table maybe, or making it less likely. The market's responding to that. Big tech very much front and focus. And the real question to me is, do we get a more motley picture with the likes of Meta, with the likes of Apple and Amazon reporting after the bell than we did with Microsoft and Google, which put out solid earnings, but people just weren't impressed?
Before we talk about tech, we need to talk about the financials. We seem to be at the phase of the cycle where we talk about banks we've never heard of before. One in Japan, another in New York. Commercial real estate is something that's been hanging over this market for a long, long time. Are we starting to see a little bit of a reality check on that side of things?
So the reality versus the fiction. The fiction that some people might say is this another crisis in the making in regional banks? And most people say no. New York Community Bank Corp was an idiosyncratic story with respect to the mix of holdings. That said, you have serious concerns about a reckoning that has not happened in commercial real estate. And those were just exacerbated with the Azora Bank in Japan reporting a 20% drop. Just are seeing a 20% drop in their shares as a result of U.S. property losses. So again, it's the shoe that hasn't dropped in commercial property, not necessarily fears of a banking collapse.
This is your world, so let's talk about it. These things have not been marked to market. A lot of these banks thought they could hold them to maturity and hope that things would get better. That maturity wall seems to be on the horizon now, end of 24, start of 25. And you just wonder how much more of this we see. Banks coming out and saying, you know what, provisions, they need to go up.
Especially because a lot of these banks have sort of floated below the radar of having to report and sort of meet certain regulatory hurdles. If they increase the regulatory hurdles, you could see a reckoning that's more significant. Barry Sternlicht recently, this week, said that he expects about $1 trillion of losses in the office space asset class. How much of that are we going to see in the bank balance sheets, especially given how much they really have lent in this
These
space?
are the scars of the pandemic when it comes to real estate and commercial real estate. And he said there's $1.2 trillion of losses spread somewhere. Nobody knows where they are. So when does this come home to roost?
We've got a decent idea of where they are. Smaller banks, not larger banks. JP Morgan had the numbers on that. I think if you look at the amount of loans here, Lisa, commercial real estate loans account for 28.7% of assets at small banks, according to JP Morgan, compared with just 6.5% at bigger lenders. Once again, it seems to be a series of events where we sit here and say the problem is not in the larger banks, it's in the smaller ones.
And it just hasn't been revealed yet. And that's the reason why we saw the KBW Regional Bank Index have its biggest daily sell-off yesterday since what we saw with Silicon Valley Bank. Key question to me is, does this rise to the threshold of mattering to the Fed? Turns out yesterday, no one asked, but it seems like everyone we talked to said no. But to me, I mean, it didn't seem like it factored into their calculus. So if this isn't a systemic issue, you're not going to get sort of the relief valve, at least from that vantage point.
You almost framed that perfectly. What we should have said, did it rise to the threshold of people in the news conference caring about it? Apparently it didn't.
Yeah, exactly.
Need to talk to Mike McKee about that. Why on earth nobody asked about the situation in the banking system just yesterday?
Well, in defense of the journalists, given that this was an evolving story, it broke just before Jay Powell came out, he likely would have just brushed it off and said, I don't have enough information yet to comment on it. And then you've wasted your question.
The rules of surveillance don't defend journalists, okay? Equity futures on the S&P 500 positive here by 0.4%. The S&P a little bit higher, bouncing back. Yields higher too, up 3 basis points, 394.43. Bramo on a 10-year, I think that was the first close below 4% on a 10-year in more than 2 weeks.
And it came despite the fact that people were repricing the likelihood of a March rate cut. But if you take a look, they're pushing them out. It seems like the Fed is very much in a posture to cut rates and is really trying to embrace this immaculate disinflation. So it seems like the bond market's cooperating.
Coming up on the program this hour, we'll talk about that with Marvin Lowe of State Street as the Fed appears to dash hopes for a March cut. Bloomberg's Alex Webb with Amazon, Meta and Apple set to report after the close. And Jennifer McKeown, former Bank of England economist, counting us down to the rate decision from the Bank of England in just about an hour. We begin with our top story. Fed Chair Jay Powell pushing back on a March rate cut. We're not declaring victory at all. I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting. Marvin Lowe of State Street, not surprised, writing, quote, strong consumption growth and a still relatively robust jobs environment would push back against the view that we are really in restrictive territory. Marvin Lowe joins us around a table. Morning, Marvin.
Morning, thank you.
What did you make of that performance yesterday in the news conference?
You know, it was interesting, for sure. I think there's been more discussion about this presser than we've had in a while, where everything kind of, if you will, packaged around. Yeah, I think it was a fairly positive view ultimately for the economy. The market got ahead of itself. You know, we had been saying that March really didn't make sense. The data was strong. Consumption was certainly out there from the perspective of really continuing to support kind of a slower inflation down ramp. But we heard from the chair that all inflation needs to do is do what it's been doing, and they're going to start cutting. And, you know, I view that as pretty positive for the markets ultimately.
Straight to the statement, the committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. So everyone wants to know that we asked about 20 different ways in the news conference yesterday.
For sure.
How do you get greater confidence? What does that mean?
You know what? It really sounded to me as if Chair Powell was ready to cut. You know, he really liked the data. He, you know, highlighted that ultimately we need to just continue to see what we saw. I think a lot of this is hurting the FOMC cats. I think you mentioned it yesterday, Lisa, later in the afternoon. I think the cats are ornery and they're kind of running around, and it's a matter of time. You know, this data is going to continue moving towards that target, particularly, you know, the PCE discussion that we've been having over the last couple of weeks.
The cats are ornery, and that's the reason why you got a really sort of muddled response. It was the data is good, the data is going to happen, and then we're going to respond to it. That was his explanation of what he's looking for. I am curious about kind of what the parameters are, right? What the hesitation is, if you think that the market now is pricing in the right chance of a March rate cut at 37%.
Yeah, so a couple interesting things. One was, for the first time, he said that they're looking at inflation from an aggregate perspective. So kind of that pushback that, you know, services inflation has to get to a certain point, housing inflation has to get to a certain point. I think that's where the holdup is for, you know, the ornery cats, if you will. But if inflation moves in the right direction, they'll be able to start normalizing. And remember, we're talking about normalization. We're talking about a Fed that thinks that there's several hundred basis points in restrictive territory. They could start the process and really see how those more sticky types of components move and whether or not we get to maybe some of the more aggressive market pricing.
If you channel an ordinary cat and you think about what happened with New York Community Bank, and you think about what happened with potential losses that have not yet been revealed, does that on the margins make you more likely to move into an easing posture?
If it develops to something greater than what we saw yesterday, yes. I would add that nobody asked about that bank, and the Fed actually took out the section that they previously highlighted, which was very much bank-related. So it's not an issue for them. And I think, commercial real estate certainly is this brewing problem that we all know about. Banks are regulated. It's nothing new, ultimately, unfortunately. And it's not going to become systemic. So, if it balloons and there are pockets within portfolios that surprise us, for sure. But, I'm operating that we've known that there's a commercial real estate problem now for several years.
So, Marvin, I think you've touched on the right word. There is systemic risk, and then there is just a massive headwind to profitability for an industry group.
Yes, yes.
Where are the financials now going through the rest of this year, given the fact we've got to deal potentially with some big unrealized losses in commercial real estate?
Yeah, working for a bank, there's always things that are thrown at us ultimately. It's a challenge. We are, when you're investing in a bank, you're investing in that management team, you're investing on how they approach their loans, and ultimately how the market views the viability of that bank from a deposit perspective. And that doesn't change. So it does come down to individual bank
Does
analysis.
it lead to tightening lending standards, though? For someone who's looking at the broader economy at the moment, is that something you should be concerned about? That ultimately, they're going to have to hit the brakes on the economy?
Sure. Yeah, for sure. And that is part of the tightening process. It's not necessarily wrong to expect this late in the cycle to have more tightening than we've seen.
That's the reason why it sort of begs the question, are people pricing in too much perfection?
Yes.
Okay,
Yes.
So then where exactly, especially given the fact that it really has been led by the Magnificent Seven, or what Mike Wilson thinks should be the Magnificent Four. But I am curious about whether you see sort of a risk-off kind of tone, especially given some of the consensus that we've been hearing, everyone kind of being bulled up.
Yeah, I mean, I think the everything up rally is done. I think we need to parse through and really figure out what parts of the story we want and we want to hedge. There's a reason that U.S. tech is where it is. I still like the earnings power, and as a little bit more of a longer term investor rather than kind of a trader, if you will. It's undeniable that they have this moat that is the envy to any other company in the world. The U.S. exceptionalism is a story that's really starting to come out. What the Fed is focused on versus what the ECB, what the BOE, and a lot of the other central banks are worried about is very, very different. And then, I think that there is tail risk from both inflation not necessarily packaging as well as the market is saying. You can hedge that. Energy is a hedge if you wanted to approach it from an equity perspective. And then recessionary-wise, there are certain markets in the world that have more value, if you will. The UK comes to mind from the perspective of a very staples-driven value kind of market.
Wait, just before we let you go, UK being a bright spot, haven't heard that in a while, especially given the fact that they just saw inflation go up for the first time in 10 months, CPI, and they have a weaker growth outlook than the vast majority of G7 nations. Why is it appealing to you?
You know what, I wouldn't say it's a bright spot. What I would say is that it provides a hedge for those that are worried with a larger global downturn in growth. Their markets would be more supported in that kind of environment.
Marvin, you're going to stick with us, I'm pleased to say. Marvin Lowe there of State Street. Equity futures on the S&P positive here by 1/3 of 1%. Lisa, I was just going through the numbers. Apple, Amazon, Meta, 12% of the S&P 500 across 3 names.
It's ridiculous. I mean, we saw 11% report on Tuesday, which is the reason why everyone cares about this so much. Key question again, how high is the bar? And to me, the Apple, Amazon, Meta story is much more interesting than the behemoths of Microsoft and Google that sort of are winning the AI game.
Those earnings coming up a little bit later on this afternoon. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. EU leaders have struck a deal to send 50 billion euros in financial aid to Ukraine. The agreement happening after Hungarian Prime Minister Viktor Orban lifted his veto on the package. Under the deal, EU member states agreed to debate the implementation of the aid package every year. The breakthrough avoids a contentious split with the EU and marks a significant boost for Ukrainian President Volodymyr Zelensky. Top Silicon Valley executives were grilled on Capitol Hill over online child safety. Ranking member Senator Lindsey Graham says the social media giants must be reined in.
Mr. Zuckerberg, you and the companies before us, I know you don't mean it to be so, but you have blood on your hands. You have a product. You have a product that's killing people.
The Senate Judiciary Committee wants Meta, X, TikTok, Snap, and Discord CEOs to endorse proposed bills for stronger protections for children using the apps. Seven-time Formula One champion Lewis Hamilton is on the verge of a shock move to Ferrari for the 2025 season, according to reports. Hamilton recently signed a new contract at Mercedes, but is able to leave at the end of the season. Ferrari wants to pair him with Charles Leclerc next year. And that's your Bloomberg Brief. John?
Yahira, thank you. It's emotional. I've got no one to share this with.
I was going to say, who are you going to share this with?
Absolutely no one to share this with. So I share it with you at home. It's the marriage, the partnership we've always wanted. I think we've always felt like Lewis Hamilton has wanted this as well. And I just think it's beautiful. It may happen in 2025. And I'll be there, September, Monza, Italy, 2025, just to see that happen.
Just so you know.
Just to connect with the audience. I knew no one around the table wanted to connect with me on that story.
I'm interested in this trip to Italy, but...
You want to come on board for that? Up next on the program, a border deal hitting a wall in Congress.
This is not conjecture. It's not Republican talking points. This is what the experts at the border, at the epicenter, tell us is necessary and needed.
That's coming up next, live from New York City this morning. Good morning. You're watching Bloomberg TV.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Live from New York City, here's your equity market bouncing back by a third of 1% on the S&P 500 following the biggest one-day loss going back to September on the S&P. Under surveillance this morning, a border deal hitting a wall in Congress.
House Republicans are not here to supply more buckets. We are here to stop the flow. And stopping the flow is not rocket science. It takes political courage. It takes transformational policy changes, and we know what policy changes will accomplish that. This is not conjecture. It's not Republican talking points. This is what the experts at the border at the epicenter tell us is necessary and needed.
Here's the latest this morning. House Speaker Mike Johnson casting doubt on a deal to secure the southern border, leaving the fate of the Senate's bipartisan bill in question. The latest Bloomberg News Morning Consult poll showing voter concerns about immigration gaining ground on the economy is the top issue. 6 in 10 swing state voters say President Joe Biden bears responsibility for a surge in migrants at the U.S.-Mexico border. Ed Mills, a Washington policy analyst at Raymond James, joins us now for more. Ed, let's talk about the deal we can't get done, and then we'll talk about a deal in the House we just got done. How difficult will it be to find agreement on addressing the southern border?
Well, the Senate's going to move first here, and we're going to see if the Senate can actually get legislation released, working on that. But if the Senate were to pass a border deal and the Speaker were to bring it up in the House, he'd be former Speaker Johnson. There's no political desire among a core group of House Republicans to get this done. There's a core desire among a core group of Senate Republicans to probably not get this done. So we do look at this very much through the political lens. You highlighted kind of the impact on the presidential elections. When we look at polls, when we talk to pollsters, the border, inflation, geopolitical risk are some of the biggest drags on President Biden getting reelected. And so for Republicans, they're not very interested of handing kind of a win to President Biden because they clearly have an alternative candidate when Donald Trump.
Well, Ed, let's talk about the bill that did get done overnight, except Senator Chuck Grassley in the Senate saying the quiet part out loud when it comes to what the upper chamber may do. Passing a tax bill that makes the president look good, mailing out checks before the election means he could be reelected, and then we won't extend the 2017 tax cuts. Do you expect this tax bill that passed on a massive bipartisan support overnight to actually get passed in the Senate?
I think it has real momentum, Anne Marie. I don't think that this is a kind of guarantee, but when you look at this bill, it has a couple of provisions that are really important. First of all, it always gets this headline that it's $78 billion. It's actually much more than that. For 2024 tax returns, it's $125 billion benefit for research and development, bonus appreciations for corporations. It's $8.3 billion in expansion of the child tax credit. Also in the bill is tax relief for those who got disaster aid in 45 states. And so the momentum has built on this bill. It's not yet kind of clear exactly the timing in the Senate, but I think it has a greater than 50% chance because with that momentum and that 357 to 70 vote, it's hard to be that individual in the Senate who's opposed to this, especially as there's so much pressure to get this across the finish line. But as you mentioned, we are in an election year, and politics absolutely will play a role in kind of how fast and if this gets done.
And the White House already has come out and said they want to sign this bill into law. But what kind of amendments could we see from the Senate side?
So I don't think there's much time for amendments in the Senate side. What we are hearing in terms of conversation is a desire to maybe expand out the state and local tax deduction. There's going to be a vote potentially in the House on that sooner rather than later, expanding it from a $10,000 maximum deduction to $20,000 for individuals that in households below $500,000 of income. That's going to get headlines. That's not going anywhere. In the Senate, they've talked about some of the provisions of the child tax credit being too expansive, the fact that you can choose 2 different calendar years for getting the benefits. So right now, I think if there is real opposition, this dies because remember, the tax filing season started on Monday. We're in overtime and we're trying to change tax policy for last year while the tax filings are already underway. There's not much time to get anything changed.
Ed, I was really struck by all the articles and research that I read about this, about the dissent from the Freedom Caucus. And I keep wondering, given that sort of tension, why Mike Johnson isn't going to go the same way that Kevin McCarthy did.
It's a great question, Lisa, but, you know, this is something that passed with 357 votes. I mean, it's unusual to have something that this is bipartisan. Yes, there was a core group of House Freedom Caucus members who were opposed to it. There was a small group of members from high tax states, the SALT caucus, that were opposed to this. But what Speaker Johnson said is if there's a bill that has overwhelming support, he's going to put it on the floor. He's not going to kind of fall on his sword for this. He will fall on his sword or kind of make sure that the politics of the border bill are done. But this is something that has momentum. And what I've been telling investors kind of to take a step back is that there was a real concern when Republicans got a majority that we could see a fiscal drag and real budget cuts. And when we look at what we're going to do on appropriations over the next month, if we get a defense supplemental, we could pull that out of this border versus defense deal. If we get this tax benefit, the spigot's still on. And that adds to the conversations of whether or not we're going to have a soft landing, because a lot of support is out there, especially for the households that are at the lowest income level that has the biggest concern of dwindling savings. Bills like these actually help quite a bit.
I guess to put a bow on it, is it that Mike Johnson has sort of more cohesion among his party, especially with a presumed nominee for the presidential election of Donald Trump? Or is it just that people are getting too tired to keep fighting and keep just throwing out their House Speaker?
Lisa, I think it's more of the latter. He has done things that have disappointed individuals, but he hasn't crossed kind of that threshold. And the fact that we went through kind of so many rounds before we chose a new speaker here in DC, and there's no heir apparent after that, the opposition probably comes maybe from some more of the moderates, and there's just not a real desire to show a lot of dysfunction among House Republicans any more than it's already occurred, because they think that would hurt them come November in keeping the House. So, you know, it's nice when you don't have someone who you know is going to be easily replacing you when you're in a position like Speaker Johnson.
Ed, good to catch up. Thank you, sir. Ed Mills there of Raymond James. Thank you. Marvin Lowe of State Street still with us around the table. Marvin, here's a tough one for you. Can you have an outlook for 2025 without knowing who's going to win the election this year?
It's tough. It certainly is tough. You know, the Trump policies would be such a departure from kind of where we are now that it is very, very hard. I think you're starting to see some of those bets being made. You know, each one of these polls, as we kind of move to a national stage rather than kind of looking at the regional primaries, even though we've still got a lot left, is starting to make its way into customer conversations for us, at least.
Don't you think these conversations are happening at the Fed? If you look at 2025, politics affects policy, which affects the economy. Don't they have to start caring about who's going to be in the White House?
You know what? They shouldn't. So, you know, the Fed obviously is supposed to be apolitical, but from a deficit perspective and really worrying about the Treasury market, you know, I do think that those conversations are out there. And I think part of the Fed certainly doesn't want to be at the helm of a recession. But part of really this pivot discussion over the course of the last couple of quarters, to me, is to avoid a recession, just because the amount of debt that would come about from stabilizers around that. You know, I think that's part of the calculus for them.
You said two things. One, that bets were starting to be taken, and two, it was coming up in customer conversations. How are they expressing this in markets right now?
Yeah, you know, certainly folks are starting to really think about how trade might get affected. That wound up being clearly one of the more changes under the last Trump administration. You know, Mexico and whether or not it winds up being at the eye of the storm the way they were last time is certainly conversations around that. And then really over the overall plan to tax everything and whether or not there's an inflation component associated with that, because the last time we tried to tax everything, inflation actually went up. So, you know, there's hedges around that. I think those are our conversations these days.
Interesting. Marvin Lowe, State Street. Marvin, great to catch up.
Thank you.
Lisa, I imagine we'll have more of those conversations in the weeks and months to come.
Especially because the two policies aren't as different as some people might suggest.
It's true, too.
Yeah, so it's sort of, you know, either way.
Coming up shortly, counting you down to earnings from Apple, Amazon, Meta after the close. Live from New York City. You're watching Bloomberg TV.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
Yesterday was pretty interesting, let's put it that way. In the equity market, bit of a downdraft, biggest one-day loss on the S&P 500 since September. I think of the Nasdaq, biggest one-day loss since October. State of play this morning, bit of a bounce, positive 1/3% on the S&P. On the Nasdaq, up 0.5%. In the bond market, interesting morning going into the afternoon. Had some ECI data, small downside surprise, and then the big thing kicked off. Started to worry about banks all over again, yields aggressively lower, then lower again in the news conference, and then we finished lower, I think, by about double digits, basis points, 2-year over to the 10-year, Lisa.
Basically, people looking at the fact that the Fed is probably less likely to cut in March, but still on an easing path this year at a time where we're clearly seeing the stresses coming up still from the commercial real estate problems that people have been talking about for years. Still, though, the unknown is looming, and the unknown being reported as potentially more than expected is spooking some.
So Chairman Powell was not a snooze. The ECB last week was. The euro looks like this, 108.04, negative by 0.1%. I have to say, just to sit on the story just for a moment, that is a big aid deal that's come out of Europe today, Anne-Marie, for Ukraine. And the difference between Europe and the United States is pretty stark once again.
Yeah, 50 billion euros. Ukraine desperately needs this. We've heard from President Volodymyr Zelensky talking about the fact that they really need some of this aid, and they're suffering on the front lines because of it. Interesting, they were able to get Hungary's Viktor Orban on board, Jonathan, to get this deal across the finish line.
What's amazing, though, that number, can you imagine if the Europeans had invested that number themselves in defense over the last 5 to 10 years?
Well, this was the complaint you heard from the former President Donald Trump that we then spoke to Mark Rutte, all three of us, at Davos about, and he said this was appropriate in terms of a criticism for Europe. We should have been investing in our 2% defense, and now they're going to have to start. You saw a complete 180 from the German Defense Ministry when you saw Russia's invasion of Ukraine.
That's a big change. 108.05 on the euro against the dollar. Under surveillance this morning, Fed Chair Jay Powell dashing hopes for a March rate cut. Speaking after the decision to hold rates, Powell saying, quote, "We're not declaring victory at all. I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting. Market odds for cuts in March have fallen from over 50% to just over 1 in 3. Lisa, I think we should leave the quote up because he doesn't say no. He says it's just not likely. And I think the economic data between now and then can always change that conversation and change it fast.
Which maybe makes tomorrow's jobs number really live, right? We might actually get a pretty significant.
Sure.
Yeah, I mean, if it's a real downside surprise, suddenly March could be back on the table. The bigger takeaway is they're ready to ease. They're happy with what they see. They just want to keep seeing more of it. So now how do we price in exactly how much they're going to cut? To me, this sort of puts the Fed on the back burner in my mind and puts earnings very much in the front and center.
Yeah, I think you're right. And also I'd say this. I think the earnings and the data specifically, I think the Fed views this quite asymmetrically now. Good data is not a problem.
Yes.
I've been pretty clear about that. If you told me 12 months ago is good data a problem, I would have said yes. The Fed chair told you yesterday it's not. And we now know that if the data gets weaker, they're willing to step up more quickly.
It's a great point. They are not scared of strength. They want to see strength. He even said that explicitly. This idea that you can get strength and have your cake too in the terms of disinflation is something that's new.
Let's talk about where there is no strength right now. Worrying signs in the banking sector and commercial real estate. New York Community Bank Corp plunging as much as 46% yesterday after the bank's loan loss provision surged to $552 million. The bank took on part of Signature Bank last year during the crisis in regional banking, including a pair of troubled loans for a co-op complex and office space. One bank in Japan also sinking, warning of a $191 million loss tied to commercial real estate in the United States. I said at the top of the program, we're at that phase of the cycle where you talk about banks you've never heard of before. I've never even read that name now.
I know, which is the reason why I didn't read it, and I'm laughing.
Lisa, this is where we're at now. Easily spooked about something we've been talking about for a while.
It's the idea of losses being bigger than we previously expected, and I think it's Aozora, probably, in Japan.
Nailed
That's how
it.
I pronounce it. But honestly, I'm looking at this. It's the idea of bigger losses than expected. We've known this is a problem. Have we been accurately pricing it? Not necessarily a systemic issue. It's this question of, have we adequately accounted for weakness in sectors like the office space sector that are just existentially challenged, according to some?
We're speaking to Chris Marinac of Jenny Montgomery Scott on the regionals and the smaller banks. I'm looking forward to that conversation, I think, in the next couple of hours. Lisa, I'm going to use a word, not my word, a word that will be used around New York Community Bank Corp. Idiosyncratic. How idiosyncratic is New York real estate given the change in regulations over the last couple of years?
A lot of people would say that it's idiosyncratic in terms of the depth of pain, the depth of loss, particularly in office properties, and the sort of bifurcation between office property that's used and that's definitely invested in and expensive, and those that are just being left for dead. That said, it's not that idiosyncratic in terms of office space and other types of sort of reckoning that have not yet been fully priced.
It certainly wasn't taken that way yesterday, given the move we saw in the regional bank index from KBW. You said it earlier, I think down something like 6%. Worst day going back to spring of last year. Deutsche Bank with some news this morning, slashing 3,500 jobs. In earnings this morning, the bank also raising its revenue target with a plan to buy back 675 million euros worth of shares. Deutsche Bank outperforming peers. BNP Paribas, messy, according to one analyst. ING sliding after missing estimates and lowering expectations. Deutsche Bank this morning, Bramo up 5%. Look at the different story over at BNP. We're down 7 there. ING also down almost 8%.
And Deutsche Bank has said that they're going to actually make additional cuts after already cutting pretty aggressively and seeing their expenses come down. What I think is interesting about BNP and ING is that everyone's been saying, okay, it's finally the time for European banks. I want to get some of those people back on and say, okay, is it really still? I mean, are you reassessing how much this is really going to fuel earnings in a new way for the banking sector in Europe?
The latest on Deutsche Bank, BNP and ING this morning. Big tech earnings coming after the market close. Apple, Amazon, Meta, all coming off a strong year of gains. Apple looking to avoid a 5th straight sales decline, which is amazing when you look at the share move of Apple over the last year. Investors looking to Amazon and Meta for progress in artificial intelligence while avoiding disappointments like Alphabet and Microsoft earlier this week. Bloomberg's Alex Webb joins us now for more. Alex, let's start with Apple and just think about the move we've had over the last 12 months. Fantastic rally. And the fact we're discussing whether they can avoid another sales decline. How do we reconcile those two things?
Well, they still post remarkably good EPS growth, right? They're looking for, the market's looking for a 12% bump in EPS, earnings per share in the most recent quarter. They find a way, even as the top line numbers slow, of leaning more into the high margin products. So if you're selling the iPhone you want to be selling is stuff with a lot of memory, because the margin on memory, really, really good. If you're experiencing growth in your services business, that's things like the App Store, where it's basically software and very high margin, things like iCloud, all those sort of things. They really managed to squeeze the profit out of sort of every last dollar. And, you know, it's very much Tim Cook's Apple.
At this point, is the bar fairly low for Apple, given all the bad news that's been coming out? Is it lower than, say, for a Microsoft and a Google?
It's certainly not been trading anywhere near the multiples of Microsoft, which is at something like 36 times its forward earnings. Apple's more in the sort of mid-20s at the moment. So with that being the case, quite possibly. But it's still, again, one of these magnificent seven, has enjoyed you know, a pretty good year, as John was saying. I think, though, there is people are aware of there being quite a lot of headwinds. I think it's been quite well telegraphed that there are problems in China. The really interesting thing will be seeing quite how bad those problems are. There was some reporting from an analyst last week that suggests they could experience a 30 to 40% sales decline in China in this calendar year, or in this financial year as well. That, you know, if there's any indication of it being even worse than that, then you start to have a bit of a problem.
The reason why I ask is because I wonder if the bar is somewhat higher for Amazon and the potential to disappoint is that much greater. And I ask this because AWS has a real question mark around it, the cloud services business that has driven so much of the profitability. How much market share are they going to be losing to Microsoft, to even Google, because of not as robust of an artificial intelligence offering?
Yeah, I think it is a thing that a lot of Amazon investors are looking at. As we know, even as the e-commerce business accounts for a huge amount of the lion's share of the revenue, almost all the profit is generated by AWS, at least in the current way it's set up. And the thing that's interesting is if you look at Microsoft's numbers from the other day, if you strip out what it attributed to the AI gains of about 6 percentage points, actually the growth of its cloud business wasn't terribly impressive. That was one of the reasons actually that the share price got a little bit punished by investors in the hours and days afterwards. Now, is that because in general the cloud market is not good, or is it because Amazon is actually succeeding in gaining share in that core cloud business? Yes, the AI stuff is important and is going to get more important, but for right now, it isn't something where companies are changing their whole business just yet. That might be yet to come, in which case people want to know what Amazon's plan is. But is the core business actually still showing some resilience without that AI consideration?
Alex, I wanted to ask you about the Vision Pro headsets because they go on sale tomorrow in the store, even though they seem to have sold out in pre-sale. Is Apple banking on this future?
No, I mean, I think one of the things, and I wrote this in the newsletter last week, one of the things that's sort of misunderstood about the Vision Pro, to my mind anyway, is that Apple does not need it to be a success. There's an important caveat to that. It doesn't need to be a success as long as no other headset is a success, right? Because it can't afford for the next sort of vector of computing, personal computing, to be, on your face in terms of smart glasses or something like that, and it not to have a product there. Now, if the space doesn't take off at all, Apple's fine. It's still pretty dominant in mobile phones. It's, as of last year, the biggest seller of mobile phones and the smartphones in the world. It's got a very strong position in of course, PCs or laptops, computers, and in tablets. So if it gets a bit of a boost from this in the medium term, it won't complain. But it's less important than ensuring that Meta doesn't dominate the space in the years ahead.
Alex, that's product. Let's talk about geographies. China. What's the latest on that? You and I have been talking about this all of last year into a new year about the clampdown on foreign tech and all of that coming out of China. How have things changed?
Well, the thing that's been sort of cracked down on is very much the government, in government departments, in state-owned enterprises. The message has gone out, according to Bloomberg reporting at the very least, that you should not be owning Apple devices. The question, now that in and of itself isn't particularly bad news for Apple. It's probably a bit of a rounding error when it comes to the actual unit sales. It's more the kind of mood music, what this means actually for the perception of Apple in the country as a whole. We saw this 6 years ago where there was a sort of real upswell in patriotism where people said, oh, we need to buy Chinese. If that is happening right now, that is clearly bad news for Apple. The Min-Ching Kuo report from last week that I mentioned earlier, talking about the potential for a 30 to 40% sales drop in China, that would be clearly quite painful, particularly as China has been, up to this, the recent quarters, actually a bit of a bright spot. Having recovered from that slowdown of sales a few years ago, it was experiencing growth again there, and that's not something you could say about it globally. So it is a concern for Apple, but again, as I said at the very beginning, it still somehow manages to find a way of eking more profit out of the dollars that it does sell in revenue.
Given the mood music regarding relationship between Washington and Beijing, is this only going to get worse for Apple to try to continue gaining market share in China?
Certainly right now, it doesn't look like it's going to get any easier. I think the other concern, of course, is what it means for Apple's manufacturing base there, right? It employs directly and indirect, well, through its contract manufacturers, millions of people there. China probably doesn't want to be losing those jobs. At the same time, Apple has been gently trying to increase manufacturing capacity in geographies like India, Vietnam, and elsewhere. So at the moment, they are still very, very small, and it's very, very nascent. But any constraints on Apple's ability to build, cutting-edge devices, what it sees as its cutting-edge devices in China, is the other side of the coin that they really don't want to put at risk.
Hey, Alex, great to catch up. Alex Webb there of Bloomberg on the latest. More earnings coming this afternoon. Apple, Meta, Amazon. Some earnings coming right now. From a cruise liner that was up 162% last year. Lisa, one of the best performing stocks on the S&P 500. In 2023.
Cruises are hot.
I mean, I think that you should
Apparently,
take
yeah.
one. Yeah. Essentially, Royal Caribbean coming out. Adjusted EPS for this year is seeing $9.50 to $9.70 versus the estimate of $9.15, seeing first quarter adjusted earnings per share of $1.10 to $1.20 versus an estimate of 91 cents. Shares are climbing more. People are going on cruises. It's the post-pandemic reality, John. When are you going to go?
Have you seen the Icon of the Seas? Have you seen this ship?
No, I haven't.
7,500 passengers, 20-deck ship. It looks like a theme park on a boat.
That's what they are.
It looks absolutely ridiculous.
Well,
you should Google this boat.
okay,
It's
I'm gonna-
absolute nonsense how big this thing
Okay,
is.
nonsense for one person and just absolutely a wonderful way to vacation with family for another person. I'm just throwing that out there.
Especially if you don't like to fly. My father hates flying, so a few times we were forced to go on cruises.
What was your experience of it?
It was nice.